Good morning and Shubha Navami to all of you. Welcome to our special monetary policy coverage, which comes to you straight from Mint Street. I'm seated in the RBI lobby, and joining me from the CNBC studios is my colleague Ritu Singh. Good morning, Ritu. If you can begin by telling us what your poll gave us.
Good morning, Lata, and a very happy Navni to all our viewers. The poll, it's going to be a close call. The poll says 80% that there will be a pause this time. 20%, not insignificant, are, expecting a 25 basis point cut. Those in favor of a cut say, a forward-looking central bank should use the headroom with the low inflation print to cut rates, whereas those that are in favor of a pause say, RBI has already done enough with the 100 basis point cuts. It's provided liquidity. So now wait and assess the impact of the tariff tensions and how that plays out, and keep the powder dry to support growth when it actually needs help. But that said, the street is expecting more cuts. 70% in fact say there will be another 25 to 50 basis points cut. More are leaning towards one more 25 basis point cut, just not perhaps in October. But a dovish pause is what the markets will watch out for. Now, how the RBI communicates that is also something we'll have to see. Growth currently at 6.5% for the year is most likely going to be revised up by 20 to 30 basis points, simply because the Q1 number came in higher than expected. Inflation, on the other hand, will be revised downwards because of lower food inflation prints that we've been getting, and of course the GST cuts. Apart from this, there are several other measures the markets will watch out for. Communication is going to be very important. Any sort of support to sectors that are going to be hit by tariffs. Those are some of the key things to watch out for. But Lata, what are you going with?
I'm going with the other 20%. I think the economy is, compared to August, far weaker. There is the 50% tariff, there is the H-1B visa, and every day there is a negative news, either it's pharmaceuticals or furniture or, now even movies. I would think that, corporate enthusiasm and courage is at a very low tide, and a bit of boost is called for. Why can't we have a cut now and in December would be my question. But I think that's just an opinion. We should defer to our experts, and joining us is Kaushik Das, all economists, Kaushik Das from Deutsche Bank, Indranil Pan from Yes Bank, and the Treasury head from Stancy, Parul Mittal Sinha. Gentlemen, and Parul, thank you very much for joining us. Parul, you go first. Well, as a bond market ace player, what are you looking for? What will you do if you're in RBI's shoes?
Yeah, so this is a very tricky policy, and this is the first time I'm seeing that the markets or the traders are more cautious than what most economists are suggesting RBI should do. We also are leaning towards a cautious stance. We think RBI will hold on. I think three broad reasons. One, prudent to remain cautious in this time of uncertainty. There's a lot of back and forth on the tariff stance between India and US. We'll see if that gets resolved over the next 2-3 months or gets worse. And therefore, it may be more prudent for RBI and the government to give more targeted support to the impacted sectors. That's one. Number two, if you look at Rupee, dollar Rupee is at its all-time highs. Rupee, if you look at a long-term average, is trading on relative basket basis towards the lower or the weaker end of the range. So that already supports exporters and supports the economy to some extent. Rupee is weaker by around 3 to 5% versus the long-term average. And the third one is there is some discussion on bond market transmission not happening, and therefore this easing may support transmission even further. I think we think that the bond market transmission is getting impacted because of demand supply issues, not because of the rates needing to be even lower. And I think RBI may be more,
let me stop you there.
To give targeted intervention rather than give a broad rate cut. So we are leaning on the side of caution, pause this time, but in some way, market will watch out for if the stance or the communication is more dovish than in the previous two policies. Inflation, no doubt, has come off quite a bit. It gives the room to RBI to cut rates, but the communication...
Parul, 1 minute. Parul, 1 minute. Just tell me that if there is a dovish pause, how will market react? If there is a cut, how will market react?
So if there is a cut, and I expect cut comes with a dovish language with it, market can move lower, rates can move lower by 10 to 12 basis points. a dovish pause, market will remain largely unchanged because that is what is priced in.
Okay, fair enough. Kaushik, your thoughts?
Yeah, Lata, Shubha Navami, first of all, and happy to have you on our side. I'm in the minority camp calling for a rate cut from 6th August itself, the particular policy day when RBI did not give a rate cut, which was our call at that time. And my point is August was too early after the 50 basis points June cut, we got, which was a surprise. December will be too late. October is the perfect time for RBI to give a 25 basis points rate cut. Having waited in August, the same argument was made in August that, you need to wait and see how things play out. Now you have a lot of information. You have the tariffs, which are sitting at 50%, and there have been more talks about H-1B visa hikes. You had this issue about, other things which are coming up, which you need to be cautious about on the services sector. People who are arguing that, uncertainty is there and therefore December is the right time, you should remember that uncertainty will not go away in December. For all you know, it can increase. And if you are late at that time, that is a bigger worry rather than moving now. And if things were to settle down, it's not like even a 20% tariff will be good for India. That will also have negative impact on growth. So I would say a forward-looking central bank should think about the forward-looking growth trajectory and not the April-June GDP number, and base their kind of decision based on the forward-looking path, which I think will come closer to 6.2, 6.3 growth in October, December, January, March. The other thing is RBI is an inflation targeting central bank. From 3.7 inflation, we've gone down to 3.1 in August, and we are going to go down to probably 2.6 in this forecast round when they present it in October.
Yeah.
If you do 100 basis points downward revision to inflation and you do not cut rates, then that will be a little inconsistent, and therefore they should do it. Also remember that in June, we already had an effective easing of 25 basis points because of liquidity. So we already had that 125 basis points rate cut. Yeah. RBI then eventually took it away by doing VRRR auctions and aligning the short-term rates to the repo rate. Yeah. If you bring it down to 25 basis points lower, you're not doing much. You're just going back to the June levels. And inflation is not going to come down for this year. That 3.1% probably will come down to 2.6. But the next year's forecast of 4.5, my guess is RBI will be reducing it lower towards 4%. And the April-June number that they've given at 4.9, that also falls to 4.5%. So definitely the GST and, the disinflationary impact that we are seeing opens up room for a 25 basis points rate cut. Sure. Sooner you do, the better it is, because you should remember that transmission takes a bit of time. What I saw was that the transmission of the previous rate cuts has happened to a large extent. Sure, Kaushik. Therefore, this is a good time that RBI can think about providing an additional rate cut. It will look like fiscal monetary coordination, happening at its best. And to the points of the bond
got that, Kaushik. There are arguments on both sides. You're arguing for a cut, and Parul has been speaking about a pause. Mr. Indranil Pan, which camp are you at? And if you do expect a dovish pause, what are some of the words you look out for in the commentary? Train our ears. Will it be the inflation forecast? Will it be supporting growth? What exactly will you watch out for?
Yeah. First of all, I am in Parul's camp for today's policy, no rate cut. And very frankly, as an economist, I don't understand what this dovish pause and a hawkish pause means. And I think given the fact that the stance is unlikely to be changed, they have to be very nuanced and very careful in terms of how forward communications go. Now, from my perspective, I think the clear message, and this is happening across all central banks across the world, and given the uncertainty that is there, you can't really provide a very clear forward guidance at this point in time. And then having to chew on your words, take it away, or turn it, and therefore have a significant implication for the market. And hence, I think the best that the Reserve Bank can do is to not provide a very clear forward guidance at this point in time because of uncertainties on both sides, the growth and the inflation perspective. On the inflation perspective, yes, inflation will be sort of dropping, and to a large extent also because of the GST cuts that will provide a downward shift in terms of inflation. But I think as a central bank, They will probably be, at this point in time, looking at more the momentum of the inflation, because this is a policy-induced one-time reduction that is happening, and therefore my perspective is that they should be able and willing to sort of look through this inflation shift lower. On the other hand, we had incessant rains in certain parts of the country. I understand from a price perspective, paddy and wheat may not be impacted, but we'll have to look forward and see what is the output on the vegetables, because this is a very crucial period on the vegetables. And the one thing that has really brought inflation, the food inflation, down was the vegetable prices. On the growth side, yes, I hear very clearly from Kaushik about his concerns about H1B, the tariffs, etc. But if I actually go and talk at the sort of ground root levels, on the H1B, a lot of companies, the IT segment is actually looking at nearshoring. So they are very, and the other thing is that to a certain extent, the H1B regulations that initially hit us on one morning has possibly been eased out to a certain extent, whereby it is a one-time sort of implication rather than an annual implication. And I think the administration is very clear about the fact that the H1B issue will not strike the absolutely sort of on a skill level at the higher level. So I think there is some comfort over there, especially doctors and all are well protected, therefore, and it might not be a very severe implication for the Indian growth story.
Yeah.
On the other side,
Indranil, quickly.
On the other side, I think from the tariffs. Yeah, please go ahead, Lata.
Yeah. No, I just want quickly, Parul, dovish pause. If you very quickly tell us what will give you the sign of dovishness, assuming it's a pause.
So if the inflation forecast for next fiscal year and Q4 of this fiscal year is what we'll watch out for, because that is the main number which told the market last time that the space was very limited.
Dovish. Okay. Kaushik, one big thing you will watch out for.
For a rate cut, obviously, and if it doesn't happen, then how RBI communicates about the December rate cut. Remember that with a 50 basis points rate cut, 10-year bond yields went up by 50 basis points. So communicating that we are not cutting today, but it will be positive for the bond market, or maybe for the markets 2 months from now, that will be extremely difficult. I think cutting the rates is a much easier thing, and and then people will still hope maybe December, if there is any need, they can do more. I would look for one rate cut, and if needed, to do more in the future.
Okay, Mr. Indradeepan, very briefly, what is your GDP number? And since you're expecting a pause, what is your terminal rate, and when is the next rate cut, if at all?
Well, as I said, very difficult to provide a forward guidance, but if you really push me to the wall, my terminal rate will be 525. I don't know the timing. On the GDP, my expectation is a 6.6 to a 6.7 for the current financial year, and a 6.5 for the next financial year. We are broadly looking at the GST implications, neutralizing the tariff implications for now. We'll have to sort of go ahead and see actually what is the on-ground implication that comes out, especially we are in a very crucial phase of the festive demand, and if there's a very significant upshot in the festive demand, we may actually see that tapering out quite significantly in the third and the fourth quarter.
All right, Mr. Pan, Parul Mitra Sinha, Kaushik, thanks so much for your thoughts. We're standing by, for the RBI Governor any moment now. From our experts just now, you heard two expecting a pause in this policy, Parul expecting a dovish pause, and Kaushik, batting for a 25 basis point rate cut. It is going to be a very close call, but the markets really want to hear is future directions. If it's dovish, whether the inflation forecast is lowered, especially that 4.9% number for the first quarter of next year, that is something the markets will watch out for. Growth is likely to be revised up. Given statistically in Q1, we had a higher than expected number than what RBI had factored in. We have the governor. Let's listen in.
All of you on the last day of Navratri, and my best wishes for a very happy Dashera and Gandhi Jayanti tomorrow. Since the August policy meeting, significant developments on the domestic front, amidst a fast-changing global economic landscape, have altered the narrative on growth inflation dynamics in India. Buoyed by a good monsoon, the Indian economy continues to exhibit strength by registering a higher growth in Q1. At the same time, there has been a considerable moderation in headline inflation. The rationalization of the GST is likely to have a sobering impact on inflation, while at the same time stimulating consumption and growth. Tariffs, on the other hand, will moderate exports. As for the global economy, it has been more resilient than anticipated, with robust growth in the US and China. The outlook, however, remains clouded amidst elevated policy uncertainty. Inflation has remained above respective targets in some advanced economies, posing fresh challenges for central banks as they navigate the shifting growth-inflation dynamics. Financial markets have been volatile. The US dollar strengthened after the upward revision of US growth numbers for the second quarter. Treasury yields hardened recently as expectation of rate cuts by the Federal Reserve ebbed. Equities have remained buoyant across several advanced and emerging economies. I now come to the decision of the Monetary Policy Committee. The Monetary Policy Committee met on the 29th and 30th of last month and today to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. I shall now briefly set out the rationale for these decisions. The MPC observed that the overall inflation outlook has turned even more benign in the last few months due to a sharp decline in food prices and the rationalization of GST rates. The average headline inflation for this year has been consequently revised lower from 3.7%, which was projected in June, 3.1% in August, to now 2.6%. Headline inflation for Q4 this year and Q1 next year too have been revised downwards and are broadly aligned with the target despite unfavorable base effects. Core inflation for the year and Q1 next year is also expected to remain contained. The MPC also noted that growth outlook remains resilient, supported by domestic drivers, despite weak demand. It is likely to get further support from a favorable monsoon, lower inflation, monetary easing, and the salubrious impact of the recent GST reforms. However, growth continues to be below our aspirations. Even though the growth projection for the current financial year is now being revised upwards, the forward-looking projections for Q3 and beyond are expected to be slightly lower than projected earlier. This is primarily due to trade-related headwinds, despite being partially offset by the impetus provided by the recent GST reforms. Summarizing, the MPC concluded that there has been a significant moderation in inflation, Moreover, the prevailing global uncertainties and tariff-related developments are likely to decelerate growth in H2 this year and beyond. The current macroeconomic conditions and the outlook has opened up policy space for further supporting growth. However, the MPC noted that the impact of the front-loaded monetary policy actions and the recent fiscal measures is still playing out. The trade-related uncertainties are also unfolding. The MPC therefore considered it prudent to wait for the impact of policy actions to play out and for greater clarity to emerge before charting the next course of action. Accordingly, the MPC unanimously voted to keep the policy repo rate unchanged at 5.5% and also decided to retain the stance at neutral. I will now be dwelling in some detail about our assessment of growth and inflation which has gone into these MPC decisions. First of all, growth. Economic activity has remained resilient, with growth of real GDP surprising on the upside at 7.8% and GVA at 7.6% for Q1 this year. As suggested by high-frequency indicators available so far, domestic economic activity continues to sustain momentum even in Q2. Looking ahead, an above-normal monsoon, good progress of Kharif sowing, and adequate reservoir levels have further strengthened prospects of agriculture and rural demand. Buoyancy in services sector coupled with steady employment conditions are supportive of demand. This is expected to get a further boost from the rationalization of GST. Rising capacity utilization, conducive financial conditions, and improving domestic demand should continue to facilitate fixed investment. However, ongoing tariff and trade policy uncertainties will impact external demand, prolonged geopolitical tensions, and volatility in international financial markets caused by risk-off sentiments of investors pose downside risks to the growth outlook. The implementation of several growth-inducing structural reforms, many of which were announced by the Honorable PM on 15th August, including the streamlining of GST, are expected to offset some of the adverse effects of the external headwinds. Taking all these factors into account, real GDP growth for this year is now projected at 6.8%. This is a revision from our earlier forecast of 6.5%. Q2 now is projected at 7%, Q3 at 6.4%, Q4 at 6.2%. Real GDP growth for Q1 next year is projected at 6.4%. The risks are evenly balanced. I will now come to inflation. Inflation conditions remained benign during 25-26 so far, with actual outcomes turning out to be significantly lower than our projections. Low inflation is primarily attributed to a sharp fall in food inflation, aided by improved supply prospects and measures taken by the government to effectively manage the supply chain. Core inflation remained largely contained, with the August reading at 4.2%. This is despite continued price pressures on precious metals like gold and silver. Turning to the inflation outlook, the progress of the southwest monsoon has been satisfactory. Healthy Kharif sowing, adequate reservoir levels, and comfortable buffer stocks of food grains should keep food prices benign. The recently implemented GST rate rationalization would also lead to a reduction in prices of several items in the CPI basket. Overall, the inflation outcome is likely to be softer than what was projected in August, primarily on account of the GST rate cuts and benign food prices. Considering all these factors, CPI inflation for this year is now projected at 2.6%, with Q2 and Q3 at 1.8%, Q4 at 4%, and Q1 next year at 4.5%. The risks are evenly balanced. I will now dwell on India's external sector position. India's current account deficit moderated in Q1 this year to $2.4 billion or 0.2% of GDP. This is in comparison to $8.6 billion or 0.9% of GDP same period last year, on account of an increased net services surplus and strong remittance receipts despite higher merchandise trade deficit. During July and August 2025, for which we have data till now, merchandise trade deficit continued to remain elevated, notwithstanding rising global trade uncertainties. India's services exports, driven by software and business services, witnessed robust growth in the last 2 months, July and August. Furthermore, robust services exports coupled with strong remittance receipts is expected to keep the current account deficit sustainable during this year. On the external financing side, net FDI reached a 38-month high in July this year, driven by increased gross FDI and a moderation in repatriation and outward FDI. Net FPI, however, recorded outflows of $3.9 billion this year so far. We have data till September 29. This is on account of both equity and debt segment outflows. As on September 26 this year, India's foreign exchange reserves stood at a healthy $700.2 billion, sufficient to cover more than 11 months of our merchandise imports. Overall, India's external sector continues to be resilient, and we remain confident of meeting our external obligations comfortably. Notwithstanding the robust domestic macroeconomic fundamentals, the rupee has witnessed some depreciation accompanied by phases of volatility. We are keeping a close watch on the movements of the rupee and will take appropriate steps as warranted. I'll now be covering the liquidity and financial market conditions in the country. System liquidity, as measured by the net position under the LAF, stood at an average daily surplus of 2.1 lakh crore rupees since the last MPC meeting in August. Going ahead, the drawing down of government cash balance and the remaining 75 basis points cut in the CRR, which was announced earlier in the remaining period of October and November, will aid the banking system liquidity in the near term. Through our two-way operations, we will actively manage liquidity to anchor the short-term rates. Money market rates have been relatively stable amidst comfortable liquidity conditions. During this easing cycle from February till August, for which we have data till now, in response to this 100 basis points cut in the policy repo rate, the weighted average lending rate of scheduled commercial banks moderated by 58 basis points for fresh rupee loans. 71 basis points is on account of the interest rate effect. The moderation for outstanding rupee loans is to the extent of 55 basis points. Similarly, on the deposit side, the weighted average domestic term deposit rate on fresh deposits declined by 106 basis points against the 100 basis points cut, while that on the outstanding deposits softened by 22 basis points over the same period. Transmission of this monetary policy has been broad-based across sectors. Going forward, adequate liquidity in the system and the remaining CRR cuts will further facilitate monetary transmission. I now give my statement on financial stability in the country. The system-level financial parameters related to capital adequacy, liquidity, asset quality, and profitability of the scheduled commercial banks continue to remain healthy. Similarly, the system-level parameters of the NBFCs too are sound, with adequate capital and improved GNPA ratios. Bank credit growth, despite being lower than last year, continues to be healthy and supportive of real economic activity. I would like to emphasize here that as other sources of funding are gradually but steadily increasing their footprint, it is the overall flow of financial resources to the economy that is more pertinent for assessing flow of funds to the productive sectors of the economy. The total flow of resources from non-bank sources to the commercial sector increased by 2.66 lakh crore this year so far, more than offsetting the decline in the non-food bank credit of about 48,000 crore rupees. I shall now come to the additional measures. I have 22 additional measures aimed at, number one, strengthening the resilience and competitiveness of the banking sector. 2, improving the flow of credit. 3, promoting ease of doing business. 4, simplifying foreign exchange management. 5, enhancing consumer satisfaction. And lastly, internationalization of the Indian rupee. First of all, I have a few measures for strengthening the resilience and competitiveness of the Indian banks. The ECL framework, the expected credit line framework of provisioning with prudential floors, is proposed to be made applicable to all scheduled commercial banks and all India financial institutions. You would recall earlier a discussion paper in this regard was issued. We propose to make these effective from 1st April 2027, therefore giving sufficient time to the regulated entities. Moreover, there will be a glide path till 2031, so effectively 5 years. This is to smoothen the one-time impact of higher provisioning, if any, on the existing books of some of the banks. Furthermore, it is proposed to make the revised Basel III capital adequacy norms effective for commercial banks, again from 1st April 2027. In furtherance of this, a draft of the standardized approach for credit risk shall be issued shortly. Under the revised approach, the proposed lower risk weights on certain segments are expected to reduce the overall capital requirements, particularly for MSMEs and residential real estate, including home loans. It may be recalled that capital requirements for operational risk have already been finalized in 2023, whereas the capital requirements for market risk under Pillar 1 of the Basel III guidelines are under finalization after receipt of comments from the public. All these measures, we propose to make them effective from 1st April 2027. These measures will help align our guidelines with international standards adapted to our national conditions and priorities, and strengthen the capital adequacy framework for the banks and the all India financial institutions. 3. A draft circular on forms of business and prudential regulation for investment was issued in October last year. It has now been finalized after wide public consultations, and it will be issued shortly. The proposed regulatory restriction on overlap in the businesses undertaken by a bank and its group entities is being removed from the final guidelines. The strategic allocation of business streams among various group entities of a bank will be left to the wisdom of the bank boards. It is further proposed, this is my fourth proposal in this regard, to introduce risk-based deposit insurance premium. You are aware that today we are having a flat rate of premium for all banks, irrespective of size, irrespective of risk, at 12 paisa per 100 rupees of net deposits. We propose to bring in risk-based insurance premium. This will incentivize sound risk management by banks and reduce the premium to be paid by the better rated banks. I will now announce 5 measures to improve the flow of credit to the real economy. 1. To expand the scope of capital market lending by banks, it is proposed to provide an enabling framework for Indian banks to finance acquisition by Indian corporates. Some of the acquisition finance related to infrastructure companies is already available, already provided. We propose to now expand it. 2. It is proposed to A. remove the regulatory ceiling on lending against listed debt securities, and B. enhance limits for lending by banks against shares from rupees 20 lakh to rupees 1 crore per person, and for IPO financing from rupees 10 lakh to 25 lakh rupees per person. These had not been revised for some time. 3. It is proposed to withdraw the framework introduced in 2016 that disincentivized lending by banks to specified borrowers, those borrowers which had credit limits from the banking system on the whole of rupees 10,000 crore and above. While the large exposure framework since put in place for the banks addresses credit concentration risk to a particular entity or group at an individual bank level, concentration risk at the banking system level, as and when considered necessary, will be managed through specific macroprudential tools. 4. To reduce the cost of infrastructure financing by NBFCs, it is proposed to reduce the risk weights applicable to lending by NBFCs to operational high-quality infrastructure projects. This should give a boost to funding for infrastructure in the country. 5, since 2004, about 20 years ago, licensing for UCBs, the urban cooperative banks, had been paused. No license has been given thereafter. Considering the positive developments in the sector, including legislative amendments in the Banking Regulation Act during the last 2 decades, and in response to the growing demand from the stakeholders, we propose to publish a discussion paper on licensing of new UCBs. I now come to measures related to ease of doing business, and we have been taking a number of measures over the recent few months and even earlier. I have 7 announcements to make, including those related to FEMA. First, a large number of circulars and directions totaling about 9,000 have been consolidated. I had earlier announced in this regard, and we have consolidated them subject-wise across 11 different types of regulated entities. Drafts of the same are ready, and they shall be issued shortly for public consultation. They should certainly aid simplification. Second, it is proposed to provide greater flexibility to banks for opening and maintaining transaction accounts of borrowers, that is, current accounts, CC and OD accounts. This will particularly help borrowers which are regulated by a financial sector, for example, the NBFCs. Restrictions with regard to collection accounts are also proposed to be withdrawn. The export sector is a vital part of India's economy. To further strengthen the sector and enhance ease of doing business for them, we shall A, extend the time period for repatriation from foreign currency accounts of Indian exporters in IFSC from 1 month to 3 months. B, increase the period for forex outlay for merchanting trade transactions from 4 months to 6 months. And C, simplify the process of reconciliation of outstanding entries related to exports and imports in the respective reporting portals, the EDPMD and the IDPMS. Sixth, and these relate to FEMA, again, key provisions relating to eligible borrowers, recognized lenders, limits on borrowing, cost of borrowing, end use and reporting, etc. in the ECB regulations issued under FEMA are proposed to be rationalized. Seventh, it is proposed to rationalize FEMA regulations regarding non-residents establishing their business presence in India. I shall now state 3 consumer-centric proposals. 1, the bouquet of services offered to BSBD account holders, basic savings bank deposit account holders, without a levy of minimum balance charges, is proposed to be expanded to inter alia include digital banking, that is, mobile and internet banking services. 2, the internal ombudsman mechanism is proposed to be strengthened to make grievance redressal by the regulated entities themselves more effective. 3, the RBI Ombudsman scheme is also being revised for improved grievance redressal, and at the same time, we are also including the rural cooperative banks under the ambit of this scheme. Now, I have 3 proposals for for internationalization of the Indian rupee. We have been making steady progress in this regard. The first proposal relates to permit 80 banks to lend in Indian rupees to non-residents from 3 countries, Bhutan, Nepal, and Sri Lanka, for cross-border trade transactions. Second, to establish transparent reference rates for currencies of India's major trading partners to facilitate rupee-based transactions. And third, permit wider use of SRVA balances by making them eligible for investments in corporate bonds and commercial papers also. Let me now conclude. Despite an external environment that has deteriorated since the August policy, the Indian economy remains poised to register high growth. The sobering of inflation has given greater leeway for monetary policy to support growth, while compromising on the primary mandate of price stability. However, the MPC decided to wait for the cumulative impact of the recent policy actions to play out before charting the next course of action as India strives towards achieving Viksit Bharat by the centenary year of its independence. It would need the coordinated support of fiscal, monetary, regulatory, and other public policies to attain its goal. The recent rationalization of GST rates by the government is a major step in this direction. In terms of monetary policy actions, we will remain vigilant of the incoming data and stay focused on our objective of maintaining price stability while supporting growth. The various policy announcements today that we have mentioned will also support the achievement of the goal of Viksit Bharat. And in pursuit of this objective, we will be proactive, objective, and consistent in our communication while backing it up with credible actions. Thank you, Namaskar, and Jai Hind.
Well, I think it's as dovish pause as possible. The governor is very clearly saying that the lower CPI reading and the GST cuts have, in his words, opened up policy space for further easing. So clearly another cut is coming. We don't know the timing, but the markets are not humored at all. I think we are pushing almost 6.6. When the governor started his speech, we were at 6.54 on the 10-year. So at the moment, the markets are reacting to the pause and not to the very clear dovishness. But beyond this, I think the Reserve Bank is almost opened up a whole constitution, a whole charter of banking reform. And there are plenty over there. The ECL is the most important. The glide path from is there after 2027, but it becomes applicable in April 2027. Most of the private sector banks seem to be already prepared. It's the PSU banks who are asking for the glide path, and that has also been given. There are also other advantages in terms of risk-based deposits, and then capital market lending. I think that is the big thing for the capital markets. So we have to watch out for how the stocks are performing. And I guess the banking sector will also have a shot in the arm. At least there is no rate cut now. At least there is no pressure on the margins now. Ritu, before I come to you, let me go to Upasana and Kaushik and the economists. Upasana, what have you made of the announcement? Is there an imminent December cut? What are the takeaways?
Yeah, Lata, as you mentioned, it is clearly a dovish pause to quite an extent. I would not entirely call it dovish, but they've balanced it very well. And obviously, much going ahead will depend on data. But having said that, this is purely in line with what we were expecting. We wanted a clear guidance by RBI that there is room for further easing if data permits. And that's how exactly what they have delivered. They have kept a pause. and kept their powder dry for future if necessary. So they have highlighted the growth risks which would come about from tariff uncertainty, which is clearly the way forward. You know, the upward revision to GDP numbers also come on the back of the first half of the year being much more robust, while the second half moderating. Clearly, the growth risks are something which we have to, keep a tab on, and that is where the window for further easing will open. That's how I would say. And on the other side is the inflation bit. I think it's purely in line with expectations. Again, the downside revision. We know that the GST-led disinflationary trend had to play out, and that is what has been accounted for. Alongside even the Q2 number, which obviously has been revised down significantly by RBI because that was a known number. So I don't think there's much surprise on either of the two sides, and it is purely in line with what markets were also looking for, a forward guidance which suggests RBI is ready to act if needed.
Okay. Well, I think this policy is much more important for stock markets. The markets have done well at about 1/3% higher for the big indexes. But look at the bank Nifty, 0.7 higher. It's about 370 points higher. And that's because banks have got much more freedom. The ability to fund acquisitions, something which was not given so far. As well, more of IPO financing, limits removed on loans against shares. All these are very, very pro capital market steps that have been announced. As well, the large exposure framework has been toned down. That 10,000 crore limit will no longer apply. So banks get a lot of freedom actually after, ease of doing business clearly there for the banks. And that's why you're seeing bank stocks do very well. And of course, the feared rate cut is not just yet there. Let's see when it comes in December or in February. Kaushik, the RBI has very clearly said 4.5 is the inflation forecast for April, May, June. So it doesn't look like more than one cut more, right?
Yeah, Lata, anyway, we have a terminal repo rate at 5.25. As I told you that, we saw that number in June itself with effective easing happening, and then RBI started doing VRRR and took that effective 25 basis points away. So we think 5.25 will be the, terminal policy repo rate, because next year, even if you have, say, 4.25 average for the year, earlier we were thinking it could be 4.5 because of GST and food prices. We think it could be between 4 to 4.25 for the full year average of FY27. You could have, the repo rate at 5.25, so 100 basis points positive real rate. So that should be okay. The only thing is, if you see whatever I said in your pre-policy discussion, that forward-looking growth would be revised down. If you look at January, March, RBI is saying growth is at 6.2. That is what they're expecting. And April, June, they're saying 6.4 instead of 6.6. So we are sub 6.5% for the first half of next year. And on inflation, as I told you, they'll bring it down to 2.6. They have done that. So from 3.7 or higher, we have gone down 100 basis points. And RBI still has not reacted. In my view, RBI could have cut rates today itself with all these arguments, but they've decided to hold on and do it in December. We'll see how that plays out for the bond market as well as the effective transmission. Because if you give a big gap between what happened in June and then if you're going to do in December, then you could argue it may not matter that much at the end of the year if you do a 25 basis points. But that is behind us. Now we know that RBI has held the policy rate where it is. We have to now see how the bond markets are reacting going forward and whether they are, optimistic about expectation of rate cut in December, which in my view should come. The way RBI has phrased their statement, it looks like they're kind of indicating that they're okay to do the rate cut, but they were waiting for transmission and the fiscal and monetary policy, all this transmission to take place by November. Hopefully, we'll get to know where we stand on the tariffs as well, and what the Fed has also done beyond the rate cut that we saw in September, what's happened to the global economy.
Fair point. We'll come back to you. Kaushik, we have to look at all the banking steps because they're fairly important. This is as much a monetary policy as much as it is a banking regulator statement that has come, and the stock markets are reacting to that very strongly. I want to go to Ritu to summarize those actions, but Ritu, just hold on, one word from Rajiv as well. Bond market is almost pushing 6.6, Rajiv. Is this a disappointment? Are you all not making space for a potential cut?
Yeah. So I think the issue is not necessarily the guidance. So guidance, I think, has been very balanced in terms of giving that space for future easing could open up. But I think the immediate challenge is clearly demand supply, and that's something that has been clearly visible when you look at where the bond markets have been reacting to. So I think that overhang of that is still there, and lack of any immediate measures to address that. I think that's one disappointment probably, because when you look at from June till date, in spite of the policy actions, in spite of a much more balanced guidance today, you've seen that the transmission in the market has completely got, I would say, reversed. To a large extent, we've seen the easing in rates being reversed. And I think there's nothing really that has addressed that specific issue. So I think that disappointment, if any, on the immediate reaction of the bond market largely comes from that. And I think this is something that is a little bit more structural in terms of enabling demand going forward.
Yep. Ritu, can you summarize? I think this is a huge rechartering of banks. Main points, please.
Well, yes, a whole lot of measures for the banks. But quickly, before I get to that, the MPR, the Monetary Policy Report, is out. And the CPI projection for next year, according to the MPR, the inflation will average about 4.5%, with 4.5% both for Q1 and Q2, and 5.1% for Q3, and 3.9% in Q4. So do expect inflation to remain above that 4% comfort level for the better part of the first 3 quarters of the next financial year before it finally eases to 3.9%. That is an important number to keep in mind when we talk about further space for policy easing. But yes, like you said, so many measures for banks, very much a banking policy, large exposure framework, some relaxation in that for capital market lending. Importantly, if one more thing I wanted to highlight is the draft circular on business and prudential regulations, which was this overhang on the likes of HDB Financial that, the parent entity and the group entities cannot have overlap in business. That has now been removed, and it will be left to the board's discretion. So this is good for, banks like ICICI Bank, for HDFC Bank, that do have their own home loan subsidiaries, with some overlapping businesses as well. That will come as a relief. The ECL framework, the fact that it is only kicking in from April of 2027 also gives banks some leeway, to ramp up the provisioning. So that is also something that the RBI has announced. A whole lot of measures on, ECB norms under FEMA. Those have been rationalized. Support measures for exporters. That should also help. Other measures include, since 2004, urban cooperative bank licenses have not been granted. Those will also now be, considered. A proposal has been mooted for a discussion paper. So, we'll have to go through all of these announcements. But, coming back to the MPR, inflation remaining higher than 4% for the better half of FY27. Kaushik, keeping these numbers in mind, do you expect the chart of the policy, or rather the pause, to be slightly longer?
Not necessary, because we had the last rate cut in June, and by the time you come to December, most of the transmission of the previous rate cuts would be behind us. Yeah. And that time RBI probably would find kind of adequate justification to kind of give an additional rate cut. By the way, I don't know whether you've seen it or not. I'm reading the MPC statement. It seems that 2 members, Dr. Nagesh Kumar and Professor Ram Singh, were of the view that the stance should be changed from neutral to accommodative. So there have been a lot of, kind of discussion within the MPC. And if 2 members thought that the stance should be changed back to accommodative, it was as if like they were almost willing to give a rate cut in this policy itself. And they were much more on the dovish side compared to the other 4 members. So I would say still that December would be a, kind of good time. If you've not, my view was that you should have done in October itself. If you haven't done it for whatever reason, then December you should do it, because February is like light years away in this kind of market environment, and that is after the budget. And if you have done the last rate cut in June, then February is too far away. So I would assume if you have to do a rate cut, December would be a good time, and then let the real economy adjust with the transmission that happens, because you would also expect RBI to hold on to these levels of repo rate, say 5-quarter, for 15 to 18 months before they decide to raise it again at some point in the future. So you should not delay it too much. And in this kind of environment where growth is always at a risk, it is better to err on the side of caution. If it is a little lower, it doesn't hurt. And as I told you, June, we were already at 5 quarter. So it's not going to be a big deal if you bring it to 5 quarter.
Yeah.
So that's my view, that December could be still very live.
No, Kaushik, the members don't get to vote on stance. The law is very clear. The Reserve Bank Amendment Act, the monetary policy framework only gives all the members the right to vote on the rate action itself. The stance was a generosity which Shaktikanta showed. Urjit Patel did not give them the right to vote on stance. So that's not something that even if they feel that the stance should change, they cannot express it because that's not within the ambit of the MPC members. It is entirely the Reserve Bank's call. Upasana, I just wanted to ask you the growth forecasts, 6.2, 6.3, would you call it ambitious? Would you call it fair enough?
I think, Lata, for now, it's fair enough. I mean, even for next year, they're talking about a 6.6% growth. For now, there are pros and cons. So we need to weigh that as we progress. And that's how we'll have to take it forward. So I think 6.8 for the full year this year, along with 6.6% next year, for now looks okay. For the inflation forecast, I believe that there could be some downside to next year's forecast, but it's always good to keep a buffer because of volatile food prices. So I think 4.5% inflation and 6.6% into next year is a reasonable forecast for now. But just if I can step in for expectations, I too would agree on a December rate cut because clearly beyond a point, if you keep pausing with transmission almost complete, then it's best to push forward, the kind of growth support that you would want to give. But I would also go one step further to say that there is a possibility of additional rate cut beyond just a 25 basis in the February policy. So by the time we exit FY26, our terminal rate could be closer to 5%. And just because durable liquidity should probably moderate into the fourth quarter, and RBI is looking to keep operating target rates closer to repo rate, it would be probably more wise to keep the terminal rate closer to 5 and keep the weighted average call rate also closer to 5% by the time we are exiting this year.
All right, let me quickly just read out some more additional information that we've got from the MPR apart from CPI. GDP growth, for FY27 at 6.6%, Q1 at 6.4%, Q2 at 6.6%, Q3 at 6.8%, and Q4 at 6.5%. These are numbers we're getting from the MPR. But importantly, while we're still awaiting the statement on development and policies to see more of these banking measures, some of the important ones, for instance, loans against shares to individuals, which was capped at 20 lakh rupees at the moment, has been raised 5 times to 1 crore rupees. So that is one of the important measures, that banks had also been suggesting, to the RBI that it has now brought in. We'll get you more details on that. Lata, large exposure framework norms as well. I think that'll be a key trigger as well, and a lot of easing as far as infrastructure financing. I think those are key measures that we'll watch out for. In the meantime, let me quickly ask Upasana again. Upasana, these banking measures aside, anything else that stood out from you from these MPR projections of CPI and GDP?
As I said, I guess I'm looking for, I think there is some downside to the inflation forecast made by RBI, both for FY26 and 27, marginally lower. And that is exactly the reason I believe that there is room for monetary easing beyond just 25 basis. Even for GDP, we are at 6.5% next year at the moment. Obviously, the risks are skewed to the downside because we don't know how long this tariff uncertainty is going to persist. And it is going beyond just goods. It's going into services, how the current account deficit is going to worsen going into next year. Most of the risks that we are seeing from the services side are going to probably pan out into next year if the problem persists. So 6.6% GDP growth next year, I would say has some amount of downside risk. But for now, probably 6.6 is okay to maintain.
Okay. Upasana, Kaushik and Rajiv, thank you very much indeed for your time. We now have the big banker himself. Joining us now is the Managing Director and CEO of Bank of Baroda, Mr. Devdutt Chand, joining us all the way from Frankfurt, where he is at a meeting. Thank you very much, Mr. Chand. Good morning to you. I'm sure it's very early morning over there. But the first point is there is no cut just yet. Is that a sigh of relief? The Reserve Bank seems to indicate there is space for one more cut.
Thank you, Lata. I believe currently, because of the market scenario, the global scenario, it's better to keep our, the cut in the coming months rather than doing it now. Considering the growth side has been very well balanced at this point of time, inflation has been very benign. I don't think there was a requirement, anything to cut the rate at this point of time. And the RBI has clearly said they would be reacting to different market scenario going forward. I think this is the best case scenario possible at this point of time, and quite happy with this.
Okay. Well, for the banking system as a whole, do margins bottom out in the third quarter as of now?
Lata, I believe as far as the repricing or the resetting of assets are concerned, they are all done. But you have to see whether this quarter has taken the full impact or the coming quarter would take the full impact. But as far as resetting, realignment are concerned, the asset side, it has been completely done.
Yeah. Okay, sir, I'll come back to the policy. I mean, it's fairly straightforward. It was an expected dovish pause. But, there is a whole lot of steps for people like you. First up is this ECL framework, expected credit loss framework, becomes law as of April 2027, but you all get a glide path up to 2031. How prepared are public sector banks like yours? Is that a bit of a challenge to be ready on April 2027?
No, Lata, I don't believe it's a challenge. Actually, banks like us who have been preparing for long. And it talks about something meeting to a global requirement in terms of the ECL framework. And I think many of the banks like us, we do have a substantial PCR on the NPA side. At the same time, also do have large standard asset provisioning as on today. So considering that, I don't think there is any way going to impact there is a glide path there to meet that. At the same time, on the system front, on the policy front also, we have been preparing for long. I think it's a right move to make Indian banking matching to the global requirement in terms of ECL. And I think there is a glide path, and all the banks, including us, would be very capable of migrating to this scenario.
Will there be an immediate rise in provisioning in FY27?
I don't think that the reason being the final computation that we have to do, but there will be marginal impact. But we, as I said, we are also holding good amount of standard asset provisioning, right? So that would take care of any additional requirement of the ECL. There will be some impact, but then you have to come out at the right time with regard to after doing all the computational part as far as the bank is concerned.
Yeah. I don't remember your reserves, but I remember I think Bank of Maharashtra in particular had huge amount of reserves. So I guess most of you will be having some standard provisioning reserves. The other big relief that has come for you all, or rather incentive to lend, is that large exposure framework goes. Now you can lend more than 10,000 crore to one group. Will that spur credit growth, you think, for banks? Will you expect a higher number this year?
It would be. This is a measure to have a higher exposure vis-a-vis many of the group entities. And as you know, many of the group entities, they are expanding in terms of capital, and it would typically give us more opportunity to lend them more. So I think it's a very welcome move. It's something can really create a higher growth for the banks in terms of the credit outgo. At the same time, allow group to expand, particularly on the Capex side. So I think it's a good move to have, and even if we operate globally, we see, the ability to lend higher definitely helps the economy to grow faster.
Okay. By the way, even deposit premiums are going to be marketized, so to speak. I guess there will be a minimum deposit insurance for everyone, but thereafter it will depend on the risk perception of the bank. Will that be an advantage for public sector banks?
It will be. We have been demanding, this is something we have been requesting for long, and I think this is one way, like the moment you are trying to, on the asset side, put risk weight and capital firm, Now, time has come to improve the quality of liability on the bank side. So the moment this kind of the market pricing of deposit happens, possibly it would allow the right kind of banks to have more deposit. And as you know, deposit has been slightly on the lower side for last many years. So I think it's a very good move for to keep a market premium for banks to mobilize deposit, and it will be positive for banks like us.
Okay. And the other very big announcement is now you can fund acquisitions. Is that opening up a new area of business, and will that push up credit growth for banks like this year and next year?
Well, I strongly believe that. As you know, Bank of Baroda, we are operating globally, and we have been doing debt financing for acquisition since long. So we have this skill set, or we have this the way to lend for the debt financing for merger and acquisition. I think it's a very good move. It's aligning ourselves in terms of international best practices on the credit delivery. And I think that would give us substantial, like Indian companies can also think of going global now also. So it's a good move to, create adequate demand from the bank side to lend more, at the same time putting our banking practices in line with the global practices. And we as a bank, we have been doing it in the global operation since long, and we are quite hopeful of doing it also in India.
Okay, well actually, let me just get some numbers from you. Do you think net interest margins will bottom out in Q2 or Q3? What's your expectation?
Once we announce the quarterly, we'll be in a better position to articulate on this. But as I said, that as far as the repricing or the resetting of advance rates are already done.
Okay.
The only thing we have to see that...
Okay, so more or less bottom.
The full impact of all this. Yeah.
Okay. And the other thing, credit offtake. What is your number for this year, either for yourself or for the sector, now that you have, more avenues to lend?
Absolutely. As I said, our full year guidance always been 11 to 13%, but exit quarter can be slightly higher than this number. As you said, as you've seen that the Q1 and Q2 almost at 11 to 12%. So we still hold on to the guidance of 11 to 13% credit growth for the full year. But exit Q3, Q4 can be a higher percentage considering all the measures announced today. And also we are getting into a busy season as far as the economy is concerned. So quarter to quarter can be higher, but overall still I think the system as a whole, the growth can be 11 to 13%.
Okay, so if you can hold on for a minute, Ritu, I'm sure you're bursting with a few questions.
Yes, Mr. Chand, just to come back to the regulatory ceiling against debt securities and IPO financing, how significant, we wanted to understand, we have exact numbers now. The RBI is proposing to enhance the limit for lending by banks against shares from 20 lakh 5 times to 1 crore, and for IPO financing from 10 lakh rupees to 25 lakh rupees per person. How much additional headroom is there, and what kind of credit will this unlock?
I think it's a positive move. Like the capital market has been very strong for many years, and now if you look, the deposit also, many people are moving to the capital market. That is what we have seen in the past. So in that scenario, a very strong capital market. Now the limits are also to be higher, so that banks can also have an indirect exposure vis-a-vis capital market.
Yeah.
So as a bank, we don't have much of exposure on this as compared to many of the other banks. But I think it's a very positive one, because since we have a very strong capital market, the payment and settlement system are excellent as far as the India is concerned. In that scenario, these limits are, I think, are in a manner which typically gives them huge opportunity for us to grow in this segment. But you have to figure it out how much exactly would be the case therein.
And what is your understanding, Mr. Chand, of the sort of relief measures that have been announced for exporters? Of course, keeping in mind, the higher tariffs that may kick in, depending on how the negotiations go, extending the time period for repatriation from foreign currency accounts of Indian exporters in IFSC from, 1 month to 3 months, to increase the period for forex outlay for merchanting trade transaction from 4 months to 6 months. And the third one is to simplify the process of reconciliation of outstanding entries related to exports and imports in their respective reporting portals. Just help us understand how important these moves would be for the exporters.
Yeah, very important. This is what actually post the tariff thing the exporters were demanding. We have been, as a bank and as a system also, we have been interacting with the exporter post these tariff measures. And I think these are going to help them in terms of creating their own liquidity at the same time. Sustaining their operation, that is more important. So all these measures earlier also when the COVID happened, at that time also many such measures were announced. And I think this is going to help them in terms of rationalizing their entire operation. At the same time, helping them, allowing bank also to have a liberal terms in terms of the export finance. And that's something I think going forward is going to be positive for the exporter.
Okay. So before we let you go, I know you have a big meeting in Frankfurt. One last question. It's about a week since, or not a little more than a week, 10 days since the GST rates have been cut. Are you noticing any spring in the step in terms of personal loans, retail loans, BNPL kind of loans? Any higher credit demand?
It is so. Post GST, I think we had one of the very strong last 10 days of the auto loans, the demand. Actually, it went up by a significant amount day-to-day basis post the GST cut. So GST is going to spur the consumption. GST is going to spur the housing purchase, the auto purchase, and all those things. And we've already seen for last around 17 days with the September month. And I think going forward, it is going to be very strong as far as the consumption, the demand from the retail, particularly on the auto loan side, many of the consumer finance side, many of these even housing sales side. I think these are going to be very strong.
Okay, sir, thank you very much. We have taken a lot of your time. It must be early morning, 7 a.m. or something for you. Thank you so much for giving us your first thoughts and have a great day out there in Frankfurt. So clearly from one of the biggest bankers in the country, the mood is very, very positive. The GST cut itself has spurred retail demand. As we heard, auto loans demand have been seeing a huge spring in its step. As well for banks, large exposure framework gone, so they can lend more, they can lend for acquisitions. And Indian companies, as we can see, every day our research team is reporting a bunch of acquisitions which Indian companies are looking at. Banks can participate in all those, they can lend more for capital market operations, lend more for IPOs, lend more loans against shares. So clearly there is a kind of a deregulation that has clearly set in, and that's very positive. And on the monetary policy side, well, bond markets are really unhappy, 6.6% on the 10-year. So bond market transmission is not going to happen, but looks like bank-related lending could find some kind of a recovery, some kind of a spring in the step. That's the word from the monetary policy that has been just announced by the Reserve Bank Governor. From Ritu and me, thank you very much for watching. We will be back covering Mint Street at 12 noon. When the governor begins his press conference. For the moment, it's a break, and then there will be a lot of discussion with stock market stalwarts on what they made of the policy, especially for the banking sector.
Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.
Hello and welcome to Trading Hour live from the CNBC TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Hormis Patakia. Well, we got that update coming by from the RBI policy meet. It's status quo. The rate has been unchanged, but there have been a slew of measures for the banking industry. We're still getting them. Of course, it was said in the release that came out, but still to get the details of that one, Ritu tells us there are around 22 of them. So we'll of course analyze that. But yes, markets reacting to that update that has come by. The Nifty is up almost 80 points. We have the mid caps which have recovered from the lows as well. The bank's doing well. So there's a 400-point uptick on the bank Nifty itself. And it is of course led by some of these private banking names. The Nifty Bank is at the day's high. This hour itself, we have a lot of them which are doing well. So we'll watch out for that one. But yes, individual updates in terms of ECL framework coming in from 2027. There's a lot in IPO financing as well. We'll discuss that and all in greater detail.
Very interesting measures announced by the RBI Governor. One such stock that is reacting to it is HDB Financial. And just get that up before we go to Ajay Srivastava. And the overhang on the stock, which was about the overlapping with the promoter businesses, that has been done away with in the final guidelines from the RBI, and that has had an impact on the stock. 3% higher on HDB Financial. It's been rebounding from its IPO price. It slipped below that on Monday, and it's now seeing some bit of rebound. This is in fact the best single day gain that the stock has had since its listing day, which was in July. So good going for HDB Financial. Ajay Srivastava, who is the CEO at Dimensions Corporate Financial Services, is now joining in. Ajay, good morning. Thank you for joining in. The policy on expected lines, if you could call it that, but the slew of measures that have been announced for the banking segment, for the IPO financing related issues as well. But sticking to banking specifically, does that ease out a lot for the banks going forward, and it's showing up in the reaction as well?
Of course, it does. I think it's a great way to kind of just put some relaxation in the policy, because we're just too stringent about everything in this country at this point of time, particularly the capital market relaxation in terms of lending against shares, IPO financing. I think it's a great move to show liberalization, and also reflects, to my mind, more than anything, a little bit of panic setting in the system to say, what would kind of revive this market and stall the FI selling, in the manner. And therefore, is welcome. It's a great step. Although from a short-term perspective, it's great. From a longer-term perspective, I think the Basel III norm, which are going to come into place, we're going to just evaluate how much impact it's going to have on provisioning. Yes, there is time for 3 to 4 years, but if you're an equity investor, you need to be wary about that in the next 3 years, how much capital will they need to earmark against the Basel III norms. I think we'll have the numbers in a day or two, and our teams will take it out. But by and large, I think for the short term, it's a great positive because the mood is relaxation, not kind of more stringency. Gold loans were kept out of it. At one point of time, the RBI governor used to hate it. Now they are kind of acceptable. But the only disappointment, I don't understand from where do they get the inflation number from? Because, and that's where the policy goes wrong. And that's why you see the yields are not dropping in the government, yields are not dropping. Is you start with the wrong assumption of interest rate and everything else falls apart. If you look at your insurance premium, look at a car insurance, look at a health insurance, look at your education, look at a healthcare, all the services you consume as a normal person. Where is this 2%, 3% inflation? It's going about 10, 20% at this point of time for most people. And that is why the governor did not say it. I was looking forward to maybe he'll explain the press statement as to what's he going to do to reduce the yield on the 10-year government securities, because the transmission of interest rate is not happening. Although you as a saver has been penalized exactly 106 basis points on FDs. So you penalize the savers. So now they have less purchasing power. You maybe compensate a little bit to the lenders, and that's why the economic policy doesn't work. So good things done, but fundamental economic policy is not working because you're working with the wrong framework of inflation numbers.
I think everyone would agree on what's happening on ground in terms of the price hikes and inflation and premiums, the things that you mentioned basically. But that's about the overall macros. There have been a lot of measures as well, which Hormuz was talking about as well. You spoke about how enhancing limits for the IPO market, that's a positive. But Ajay, here, if we look at the slew of IPOs that have come by and the kind of retail interest and subscription that we're seeing, and still they're not seeing the kind of listing gains that at least a lot of investors expect. What is your take on the entire phenomenon that is playing out?
Oh my God. They are lucky to be IPO'd and subscribed. They are what I call in our office nutcase valuation. You got to be really nutty. And I wonder the investment bankers, the mutual fund who are buying the anchor book, what exactly are they buying at what prices? And look at the companies. It's not some fancy quantum computing companies which are coming to the market. We are having already a Chakki mill coming to the market. We have a Mangal Sutra manufacturing market. The lowest of the lowest quality of IPOs are coming up with absurd valuations. I'm even surprised that they managed to squeeze through, which is a great thing because mutual funds have got money to do it. But that's not a great sign for capital market. You need to get capital to where the growth is, where the future is. We are putting capital to where the past was. Can you imagine a flour mill getting an IPO done in this day and age? It's just ridiculous. I think it's just IPO business is just ridiculous at this point of time. I'm not saying all are ridiculous, but 90% of IPOs don't deserve anything close to this pricing. And whoever is buying it 2 years, 3 years down the line, we'll see what happens to the share prices of these companies. Believe me, they will not even be half of what they're coming at today.
Showing up in the listings today as well, BMW Ventures listed at a 25% discount to its issue price, and a lot of the other listings as well. But Ajay, the other major talking point has been IT. Start reporting results from next week onwards, with the expectations are already pretty subdued for the sector itself. Do you believe that FY26 will just end up being a washout year for the entire sector, and maybe once they get their act together, we can expect some rebound from FY27?
There is an old Hindi saying ki mara hathi sawa lakh ka hota hai. The question is, when you decide the elephant is dead, so at least the tusk can be harvested. It's a one-way street of going down, IT. And I think the worst point of the IT industry's future was this 18,000 crore buyback of Infosys. That shows you how pathetic the situation is in the Indian IT industry, that they could not find anything to invest in the world. You look at the top 7 in the US, they are investing 25 billion in a quarter. And my company goes and gives back money to shareholders because it says I can't find investment avenues. Now, would you want to buy a share of such a company which feels in IT sector they cannot find anywhere to invest? Now, if that is the management which is running these IT companies, I would not put my money into this. We have zero investment in the last 2 years. We continue to have zero investment, and we are negative on this outlook for IT, not because the industry is not good. The management who are running this for their promoter shareholders, not for the common shareholders and growth. If you can't find growth in today's world and where the world is moving different tech, I think you really got to be blind or stupid or dumb or all three, in which case you don't get my money to invest in your company.
All right, we take that. Ajay, thank you so much for being so candid and honest about your opinion. That's the word coming in from Ajay Srivastava. With that, we'll slip into a short break. Up next, we'll focus on the crypto market with Manisha Gupta on the other side.
.5%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate.
CNBC TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. As promised, let's shift focus to the crypto space. Manisha is now here with more. Manisha.
In Crypto Corner today, we are talking about the month of September, which has worked out positive for crypto or virtual digital assets. Bitcoin actually is closed September in slight mild green there. And if you look at the overall market cap, that also turned up by at around $4 trillion yet again. So the US market shutdown, of course, the government shutdown assessment is something that the street is looking at. But as you've seen in last 24 hours, we've seen gains come back in case of precious metals, and so has been the case for crypto as well. The month of September also is important because ETF launches, instead of being a case-to-case basis by the US regulators, it is now an open market. So we've seen three important major ETF launches as well coming in: Rex Osprey XRP ETF, Rex Osprey Dodge ETF, and the Grayscale ETF as well. So this is our development that we saw in the month of September in sense of regulations and ETF launch. The other thing really has been about crypto adoption, and September really saw more institutional participation, more companies onboarding Web3 and blockchain as a technology. And then you had countries like Thailand and Vietnam launching newer initiatives, experimenting with crypto when it comes to inbound tourism in sense of payments there. Airlines like Emirates and Air Arabia also are now adopting crypto payments in sense of acceptance there. There also are countries like Kazakhstan, Pakistan for that matter, which are moving ahead in sense of crypto mining and adoption also. The other thing that seems to be catching up even more in the month of September in sense of numbers has been tokenization. So the interest in stock tokenization clearly seems to be accelerating in the recent few months. You have platforms like Robinhood and Kraken, which are now offering tokenized stock products. Nasdaq also has requested SEC approval for rule change to allow listing of tokenized securities on the platform, on exchange that is. And then there also is a statement from the SEC, Paul Atkins, where he says that tokenized assets could improve access to financial markets and also reduce the costs going forward. Very interesting pattern should come in on your screen, because every time history shows that if the month of September goes positive for Bitcoin, then it's a given then October and the fourth quarter of calendar year are much in positive. That's a precedent that we've seen in 2023 and 24 as well. After a positive September, October was up by nearly 28% in 2023, and October 2024 closed up by nearly 11%. And that led to positive gains for the fourth quarter of that year as well, where we saw 23 close up by 49% for Bitcoin, and the fourth quarter of 2024 closed up by 45%. So that's exactly what the markets are hoping for the month of October and this quarter going forward for Bitcoin and crypto.
Manisha, thank you for that. Take a short break. On the other side, we get you one of the listings of the day, Jain Resources Recycling. The management joins in on the other side to talk about the road ahead for the company.
CNBC TV18 presents Crypto Corner, powered by CoinDCX.
Remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%.
Welcome back. You're still tuned into Trading Hour. Let's talk about the primary market action. Jain Resource Recycling made its D3 debut with a good listing. The company, the stock listed at 265 rupees versus the issue price of 232 rupees a share, which is a 14% premium. Kamlesh Jain, who is the chairman and managing director at the company, is joining us now to discuss more and the outlook going forward as well. Mr. Jain, good morning. Thank you so much for joining in. Now that you've listed, you will be able to give us forward-looking statements and tell us more about your plans as well. You did revenues of around 7,100 crore rupees in FY25, margins of around 5%, profits of around 223 crores. With the expansion plans in place, with the increased capacity utilization, what kind of numbers are you looking at in the next two fiscals?
Yeah, thank you. So we are definitely looking for a robust expansion plan, and already, as we have discussed last time, for the copper cathode, which is going to start from the next year, and value products of copper. And we are also going to enter in many areas of recycling, like tire recycling, e-waste recycling. So company has got a robust plan for next 2 years to grow in the recycling sector, which is the main forte for us. And recycling is going to be a huge opportunity for the this next 20 years. Will grow and grow. It is not like business. It's a compulsion to recycle if we have to live the life on this planet.
Mr. Jain, good morning. Thank you for joining in. Congratulations, first up, for becoming a public company today. Now that you are operating at utilization levels of 75% and considering the projections that you are making, are you having any capacity expansion plans on the anvil?
Of course. So we always keep a 20% capacity extra to grow. In our business, it is always purchase order book matter than the sales order. Sales is always there for us. There is no problem for doing sale because it's a commodity what we manufacture, and so the base raw material for any downstream project like copper manufacturing of tube or sheets or battery manufacturing. So in whatever we are able to source, we can recycle and we can sell. So that's a circular economy solution. Our purchase book matter, so we keep 20% capacity extra. Once it gets full up, we again build up 20% capacity extra. So this year again we have created around 25% capacity extra to cover up the future raw material.
Mr. Jain, I just want to understand, how does pricing work in this case? Because I've had conversations with some battery recyclers. They've spoken about that maybe the scrap prices go down sometimes the output prices go down. Is it volatile for you as well? In that case, how do you ensure maintenance of margins and profitability?
So we have a strong and robust mechanism for hedging all our purchase and sale. our margins are not at all get affected, and it has been completely locked from day one when we purchase the material. So we hedge in MCX, hedge in London Metal Exchange, and sometime in COMEX also. As we buy 24 hours round the clock purchase, so round the clock we hedge back to back with every apple to apple. So there is no risk for any variation in the price and the margins, the profit margins. We are above the risk factors of price movements of the base metal commodities.
Mr. Jain, the last time you spoke to us, you had mentioned that exports are 60% of your overall business. If you could quantify that for us as to how much of it goes to the US market and what are the situations that you are facing from there currently, and going forward, do you expect to either maintain, bring down or increase the share of exports as a part of your overall mix?
So first of all, we don't export to US at all. Our export is zero to US market because commodities we sold only in Southeast Asia, Korea, Japan, China, Singapore, Malaysia, all in Southeast market and somewhat in Middle East market, but mainly in Southeast Asia market, where the freight cost also is almost zero for us to ship from Chennai to all these countries. Now, second point is we buy from US. So we don't sell to US, we buy a lot from US, around 17% last year purchase. And this is also we buy substantially, but our domestic purchase is going very big now. So come back to the US side, we have no effect of tariff war or anything going. And this kind of I will not call garbage, but this kind of scrap and recyclable resources, every country has to export to India only because of the India's USP, because of India's ecosystem for recycling. So Indian companies are doing very well in the recycling sector, and they will grow more and more.
Also, maybe because we don't segregate enough, and that's why some of the waste cannot be recycled also. Mr. Jain, also wanted to understand the point on growth going forward. 5% margins currently, 5.2 to be precise for FY25, 7,125 crores in terms of top line. What kind of growth are you envisaging, considering that you're saying this is a business which would continue to see growth?
As I said, recycling is not a business where it is by choice. It is by compulsion. We have to recycle if we want to live the life on planet. I mean, whether it's domestic or it's overseas. And what we do is not typical waste to energy or typical waste management. What we do is very different type of recycling. These are recyclable resources.
Yes. So, Mr. Jain, in that case, what kind of growth will you see?
So definitely the growth is, we are growing last so many years around 30-40% CAGR, and I expect same level of growth for the next years to come, and it will be maintained on a strong growth path. I can't tell exact numbers, but I am sure that the company will be growing for the years to come.
And margins, will they improve? They've improved from 4.1 to 5.2%. Will that trajectory continue as well?
Yeah. Yes, in this business of recycling, the scale is more important. So once you grow the scale, the cost of production goes down, the fixed overheads goes down, and that way the margin goes up. So when you do, our top line goes up, I am sure our bottom line margin will also go up because of the cost will go down.
Right, Mr. Jain, thank you so much for sparing time and joining us. Congratulations on your listing once again, and we look forward to having you after your quarterly results as well. The management there of Jain Resource, and bucking the trend, if you could call it that, among the list of IPOs that have gone public, have listed recently 20% higher in comparison to the issue price. By the way, the index is now at the highest point of the day. The Nifty now 120 points higher at 24,730, and all credit to the Nifty Bank. In fact, now heading to the 24,750 mark now is the Nifty, building on to those gains, and credit to the Nifty Bank, and it's back above that mark of 55,000, building on to that as well. 55,300 is the first level now to watch for on the upside. 600 points higher on the Nifty Bank after the slew of measures announced by the RBI Governor. Take a short break, more on the markets on the other side.
Detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic
Welcome back. You take a look at the bank Nifty and 600 points higher on the index. You pull up the Nifty bank constituents as well. Most of them either near or at the highest point of the day, be it Axis Bank, be it HDFC Bank, be it ICICI Bank, all of them contributing to the gains on the index and the broader market names as well. There you can see the list of contributors, ICICI, HDFC, Kotak, Axis, all of them. But the PSU banks though are sulking a little. SBI, PNB, Bank of Baroda, they've run up quite a bit as well. So not so much on the PSU banking front. That index is at the lowest point of the day. Not so much in the broader markets as well. That too continue to remain around the flat line. But the last few minutes have been all about the Nifty bank and its impact on the Nifty subsequently. But that does not take away from the fact that there are a lot of broader market movers as well. Netweb Technologies is now up 12%. And just before we get to that, on to a conversation on the auto sales. The M&M total tractor sales during the month of September were up 49% from last year. My colleague Parikshit spoke to Vijay Nakra, who is the president of the farm equipment business at Mahindra & Mahindra, and began by asking him about the September sales and the demand boost after the GST rate cuts. Listen.
What you're seeing, a large part of the performance obviously is attributed to the benefit of the move by the Honorable Prime Minister, which is to reduce GST. We are seeing the benefit of that play out at the start of the festive season. But there are two things that I also would want to add to that. One, we must understand that the festive period last year to this year needs to be understood in terms of number of days. Last year, the entire festive period was in the month of October, which means Navratri and all of Diwali, except for the last 2 days, were in the month of November. This year, the festive period has been split between September and October. So we've seen 9 days of Navratri this year in September. Dashami is tomorrow. Which is in October, and Diwali is in October. So one should actually compare the festive period performance at the end of October to look at September plus October. That's point number one. Second, I think also, the favorable monsoon with 8% higher long period average, reservoir levels at 90%, the government's announcement of a significant increase in MSP to increase the money in the hands of farmers, and the higher 2% land sowing of the Kharif period. All of this have augured well both for the month of September and will continue to play out well into the festive season of October.
Right. Now, if I were to ask you about total sales in September, you're talking about 64,946 tractor sales. How much of this came in just the 9 days of Navratri?
Again, there I don't think it's the right thing to talk about as an absolute number. And Parikshit, let me tell you why. The reason is that the announcement for drop in GST had come in earlier. So normally, if that was not the case, we would have seen some amount of spread of sales to happen through the month of September. But given that the GST benefit was to come in from 21st of September, which was the start of the festive period, deliveries pre-21st had slowed down, and all of that sort of flowed into the last 9 days of September. So I don't think it's a fair comparison, but the statement to say that it has been significantly a strong performance is what counts as far as the 9 days is concerned, whether we talk about deliveries or inquiries moving forward into the month of October.
Okay, now as of right now, as of 1st of October, what would be the booking pipeline that you're sitting on, and what could be the kind of growth you're looking on a year-on-year basis, on a month-on-month basis in October?
Difficult to give that guidance. Again, I think in tractors, we should just understand the context of booking, because, over here, you may have a lot of bookings, but what matters over here is that conversion, because, unlike some of the other segments and sectors which are lifestyle products, over here, there is a process of, this asset is one of the highest cost purchases of a farmer, and hence it's the ability not only just of the down payment, also the financial approvals that come in from the banks and the financial institutions. So all of that has to come together for finally the delivery of the product to take place. So again, I'm not getting into specific number to say what is the opening booking as we get into October, but the pipeline is very strong for us to be able to convert that into numbers in the month of October. And again, in terms of strong performance for October, I'm kind of reiterating my point that one cannot compare September to September separately and October to October separately for the reason of the festive period. But having said that, September plus October, we are confident to continue with the strong performance that we are doing with the tractor business. And I think even the industry will continue to play out very strongly.
Right. If I were to ask you about the actual demand sentiments, have you seen an actual uptick as a result of the GST reduction? Because a lot of the customers would anyway be holding back sales till Navratri because of the Shraddh period. How would you actually gauge the sentiment on the ground right now? And going forward, what would be an outlook for tractor sales across the country, even though you cannot give us an estimate right now?
Yeah, how do we gauge the sentiment this year compared to last year? I think the best measure at this stage is the kind of inquiries that we get at our counters, and that is significantly higher compared to last year. Whether you look at Shraddh plus Navratri or you look at only Navratri. So that is a very strong indication that farmers have sort of started understanding the benefit of the reduction in GST, because that plays a significant role in the input cost for a farmer. In their calculation of their earnings. So the strong inquiry pipeline gives us that indication that as we sort of get into the second part of the festive season, the demand is strong. I also want to say that, the reduction in GST is a fundamental change. It's not a festive season offer where the customers are just going to rush and try and get that benefit in 9 days or 18 days. So the customers have understood that this is a significant change that's come in. A lot of them, as they start buying tractors now, getting into the Rabi season, have started buying it in the festive period. And I think this benefit is not just a festive period benefit, but we'll probably see it play out even for the rest of the year. And hence, we believe that the second half, while the first half has seen for the industry about 11.5% growth, this sort of strong industry performance will tend to continue in the second half of the year. And I'm not giving a guidance, but I'm just saying that the strong momentum of demand should continue even post-festive season in the second part of the year.
Okay. Without commenting on Mahindra, any industry estimate as to what kind of growth the industry could post for the full year?
Difficult to put a number to it now, but like I said, we've seen a double-digit growth in the first half, and I think that sort of momentum should definitely continue, into the next couple of months of this financial year.
All right, that's the word coming in from M&M in terms of what the outlook is looking like. They expect festive season to be strong over September and have strong booking pipeline for tractors in October. Time for a short break now. We'll get you more on the markets on the other side.
Conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%.
Boy, have a look at the Nifty Bank now, 650 points higher on the index, and that has now taken the Nifty to the 24,800 mark. So almost 700 points higher now on the Nifty Bank. 55,300 has been conquered, and as of now, at least, the Nifty Bank also within 15 points away of that 24,800 mark. ICICI Bank, HDFC Bank, Axis Bank, all of them trading gains of 2.5%. And just before we wind down on the show, just pull up Tata Motors as well. It just had an announcement from the company stating that they will be announcing the record date for the CV business demerger shortly. Remember, today is the effective date of the demerger taking place. So 1st of October, the effective date, the record date will be announced shortly as well. So 3% higher on Tata Motors. And also springing up today is Trent. 3% higher on that stock as well, nearing the highest point of the day among the top gainers on the index. But with that, we call time on this edition of Trading Hour with the Nifty Bank at the highest point of the day, as is the Nifty, from Sonal and me. Thank you for watching. But just as we go into the break, here are some market opinion from Nilesh Shah, the Managing Director at Kotak Mahindra AMC, on the IPOs, the performance, the FPI outflows, and a lot more. And listen in. And there, as you can see, the record date has been issued now as the 14th of October has been the record date for the demerger of the commercial vehicles business from Tata Motors. So 14th of October will be the record date. So shareholders will be entitled to one share of the demerged CV business compared to one share of the current listed entity. And a day after the record date, Tata Motors will start trading X the CV business, and it will be renamed as Tata Motors Passenger Vehicles Limited, and the demerged entity will begin trading sometime mid-November, is what the company has mentioned, as Tata Motors Commercial Vehicles Limited. So with that, we call time on this edition of Trading Hour. Thank you so much for watching. Halftime report on the other side.
With the barrage of IPOs, undoubtedly there is no worry on the quality side. SEBI has done a fantastic job on ensuring that only quality IPOs come. Institutional investors also have done a reasonably good job in ensuring that they invest in reasonably valued IPOs. Many of the IPOs which have opened at a discount had virtually no institutional participation. So my recommendation to investors, please don't make mistake on your own. Learn from our experience and go for those IPOs where you believe there is a reasonable institutional participation. 3-6 months remain challenging. The FPIs are on the selling spree. They are saying for last 5 quarters, your earnings growth is single digit. Your valuations are at premium to historical averages. And most importantly, you are getting hit by US tariff and geopolitics. They are absolutely right in saying this. Generally in festival season, we have seen some amount of redemption to either buy a house or buy a motor car or buy jewelry. And ultimately, wealth is there for spending. So there will be probably similar intensity of gross flows, but the net flows will be lower because of the redemptions for consumption or spending.
After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. Also, consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance.
Our special coverage of the monetary policy, the Reserve Bank of India top officials gathering now to address the media after announcing that pause in policy widely along expected lines. But, you know, more than the policy measures, it was the banking measures that caught the attention of the markets that were the focus. For the first time ever, I think we've had as many as 22 measures announced for the banking and financial sector as a whole. Let's cut in, to the governor and his deputies who are addressing the media as we speak. Stand by. You know, there's really been these raft of changes as far as bank lending is concerned. You know, we've not seen this before. Acquisition financing, easing norms. Okay, there we go.
Welcome to this post-policy press conference, fourth for the 25-26. Friends, we have with us Governor, Reserve Bank of India, Shri Sanjay Malhotra, Deputy Governors, Shri M. Rajeshwar Rao, Shri T. Ravi Shankar, Shri Swaminathan J. and Dr. Poonam Gupta. We also have with us Executive Directors, Dr. Ajit Joshi, and for the first time, Dr. Indranil Bhattacharya. I also welcome my other colleagues from the Reserve Bank. As always, we'll have a few housekeeping announcements. Sir, there are around 23 participants from the media, and I request the media participants to please stick to one question so that everybody gets a chance. I'd also request everyone to switch on the mic when they are intervening so that the people listening to this transmission, they are able to listen clearly. And once you are done, please switch it off. Sir, so with your permission, I'll call out the names. I would ask Ms. Lata Venkatesh from CNBC to ask the first question. Lata, please.
Thank you, Puneet, and thank you, Governor, for the opportunity. You have said in the statement that the fall in inflation opens up space for further supporting growth. You have omitted the word limited, which was there previously when you said limited space. So should we understand there is space for more than one cut? And what are the trigger? If you had the space, why not now? What trigger are you waiting for? You also said that the transmission is broad-based. Are you okay with the way bond yields have moved? There doesn't seem to be transmission there.
Yes, there is a change, as you have noticed. I mean, inflation has reduced considerably since we met earlier in June by 1%. And so that does open up the space. At the same time, growth you have seen, while it has surprised us on the upside in Q1, Q3, Q4, and even next year, there is a downward revision slightly, and as mentioned, it is on account of the tariff, the 50% tariff that has come into play, offset to some extent by the GST. Why not a rate cut is again, given in our statement. Monetary policy transmission, while it has been good across sectors, it is still happening, and it's not only monetary policy transmission. There are other policies, for example, the government GST rate and a number of other policies announced by the Honorable PM and the government. They are taking shape and their impact is still unfolding. At the same time, there are still a lot of uncertainties. We see developments every week, every day, and we also see responses there too. There is still, clarity on that account. And so that's why the MPC felt that we should pause. Insofar as transmission to government bonds is concerned, you are aware that there was a good transmission of about from 686 peaks or thereabout to 630, about 46 basis points. And after that, there has been a hardening. So the net impact thereof is only about 660, 659 today, so about 30 basis points, more than 30 basis points, yeah, about 30 or less than 30 basis points in the government yields. We are watchful and we'll see, how ultimately it is, of course, for the demand and supply. We'll see how all the needs of the economy are supported.
Speak about limited. Why did you drop that word?
I mentioned that inflation has dropped by 1% from our earlier forecast. It is now at 2.6% from our earlier forecast. So it has dropped down by 1%, and so that's the reason. And the growth at the same time, I did mention, has also been revised slightly downwards. Primarily, of course, as I mentioned, on account of trade-related, the higher tariff that has come into play, which is still negotiations going on, etc., still unfolding. But we have taken that. To cut, not limited space. Yes, we have made that change. Yes, and that's the reason. The changing growth inflation dynamics is the reason that we have changed the language.
Thank you, sir. For the next question, I'll ask Mr. Mayur Shetty from Times of India. Mayur, please.
That's the attempt, that whatever are the external headwinds, we try to counter them. Ours is primarily a domestic demand-driven economy, so the impact is limited. is not as high as some of the other countries, as I had earlier mentioned. And the government, as well as the RBI, both fiscal, monetary, and other policies, will make all efforts to ensure that whatever are the headwinds, they can be countered. At the same time, you are aware that negotiations are still going on. Government is looking at other means, opening up other markets. There has already been a trade deal with the UK. Negotiations are on with so many other countries, including Oman, EU, etc., that will also open up markets for our exporters. And on the whole, the growth, Indian growth, has been quite resilient, and we are very hopeful that we will continue to maintain a very high growth trajectory while maintaining price stability.
Thank you, sir. Next, I'll have Mr. Manojit Saha from Business Standard. Manojit, please.
Thank you, Governor. The commentary is that inflation is coming down while there is softening of growth expected because of the trade-related uncertainties. I wanted to understand, so this clearly hints that going ahead, rates can probably come down. Rates going up is not an option. So is there a discussion to change the stance to accommodative?
Yes, there was a discussion. As you have already noted, two members want it. You don't have a vote. It's more of a forward guidance. Let me again, clarify. This was clarified in one of the earlier policies. It has got nothing to do with liquidity. It is only as a measure of forward guidance as to where the rates can be going forward. So two members, Professor Ram Singh and Dr. Nagesh Kumar, have given their guidance as accommodative, while the others have maintained it at neutral.
Thank you, sir. Next, we'll have Ms. Hamsini from Money Control. Hamsini, please.
Thank you. Good afternoon, Governor. I'll move a little from macro aspects. One of the things in the policy speech which sort of caught my attention a lot was the limits for specified large corporates. That has been sort of done away with, and the reason in 2016 it was introduced, one of the reasons cited was to also develop a very vibrant bond market and de-risk the banking sector to some extent. So now that we've gone back on that, what is the inference that one should make, that credit growth for large corporates should once again come back or be fed by banks, or despite all efforts to create a little bit of vibrancy in bond markets, it's not yet picking up? How should we infer that particular change, sir? And as a continuation to that, a lot of changes have also come pro-banking sector in this particular speech, like for instance funding acquisitions, etc. What was the rationale in making, or in opening the doors for ease of doing business for banks, granting a lot of their wants?
A lot of questions in one question only. First of all, my understanding is that the 2016 policy was more about mitigating risk and reducing, limiting exposure to large corporates at the banking system level, not at the bank level. For the bank level, I would like to clarify that the large exposure framework which was there continues. There is no change at the bank level, individual bank level. Whatever is the large exposure framework continues. At the banking system level, any borrower which was having an exposure, a credit limit of 10,000 crore rupees or more from 2019 onwards, this limit was progressively reduced from 25 to 15 to 10,000 starting from 2016 to 2019. That has been done away because it is felt that that the large exposure framework is able to take care of the needs at the individual bank level and at the banking system level. If there is a need, we have the macroprudential tools already to take care of that. Thirdly, you have been seeing, that the share of corporates in the total banking exposure has in fact, come down over the years. I do not have the right numbers. I think last 10 years it has reduced by about 10% or so. So the risks are not so many. So that's the primary reason, why we have reduced, why we have proposed to remove this large exposure framework for specific borrowers at the banking system level. And then there are a number of other measures, ease of doing business. I think we announced 7 measures on top of some 5 measures, smaller measures, which we had announced couple of days ago. That's a continuous process. We need to continue looking at rationalizing our regulations so that the productive needs of the economy are met with the least of compliance burden, with the least of cost, while at the same time ensuring that wherever prudential measures are required, they are not compromised.
थैंक यू सर. अब मैं श्री अनुराग शाह ईटी नाउ स्वदेश से आग्रह करूंगा कि वे अपना प्रश्न पूछें. अनुराग जी.
थैंक यू सर. पुनीत सर. सर, जिस तरह से आपने अपने संबोधन की शुरुआत में भी जीएसटी रिफॉर्म की बात करी, आखिर में भी जीएसटी रिफॉर्म की बात करी, तो सर जो ग्रोथ का टारगेट को रिवीजन किया गया है उसमें टैरिफ का कितना योगदान है और जीएसटी रिफॉर्म का कितना योगदान है? और क्योंकि सर 22 तारीख से ही ये रिफॉर्म की शुरुआत हुई है, तो आगे चल के इसमें और ज्यादा जो ग्रोथ का आउटलुक है उसमें और बदलाव हो सकता है. और सर महंगाई को जो आपने 3.1 से 2.6 में लाया है, तो जो जीएसटी रिफॉर्म है एक सरकार की तरफ से बहुत बड़ा ऐलान किया गया और उससे पहले बजट में जो पर्सनल इनकम टैक्स में ऐलान किया गया था, इन दोनों के बाद से लोगों के हाथ में काफी ज्यादा पैसा रहेगा और वो कंजम्पशन में जाएगा, तो वो महंगाई पे कितना इम्पैक्ट डालेगा? और सर एक पिछली बार मैंने एक सवाल पूछा था, लेकिन सर वो थोड़ा सा सही से नहीं पूछ पाया, तो अगर अनुमति हो तो बाद में पूछ सकता हूँ.
तो पहले ये जो आपने बोला है, ये सभी का जो प्रभाव है, चाहे वो जीएसटी हो, चाहे वो 50% टैरिफ हो, बेसलाइन में हम 50% टैरिफ को मानते हुए ही हमने सारे अपने अनुमान अब इसमें अनुमान में हमने उसको इंक्लूड किया है. तो लेकिन जैसा कि स्टेटमेंट में भी बताया गया कि जहाँ तक वृद्धि दर की बात है, तो जो टैरिफ है 50% का टैरिफ और साथ ही साथ जो अनसर्टेनिटी है, ग्लोबल डिमांड, इसके 2 इम्पैक्ट हैं. एक तो जो ग्लोबली डिमांड पे न केवल यूएस डिमांड बल्कि पूरी ग्लोबल डिमांड के ऊपर में जो कमी आएगी, एक वो इम्पैक्ट है जिसकी वजह से हमने, आपको मालूम है कि 20 बेसिस पॉइंट्स पहले अपनी वृद्धि दर 6.7 से 6.5 करी थी और अब एक 50% का जो इम्पैक्ट है वो डायरेक्ट एक्सपोर्ट्स यूएस के ऊपर में है, जो कि कम हो सकता है यदि जो अभी जो वार्ता चल रही है वो और सकारात्मक होती है. और जीएसटी का इसका जो प्रभाव है वो उससे कम रहेगा, हमारा अनुमान है. तो इसलिए वो पूरी तरह से ऑफसेट नहीं कर पाएगा. कुल मिलाकर के जैसा कि हमने कहा, करीबन 20 बेसिस पॉइंट्स औसतन की कमी इन सभी इम्पैक्ट्स की लेते हुए हमने ये अनुमान अपना लगाया है. कुल मिलाकर हालांकि इस साल में चूंकि पहले 6 माह में अच्छा इकोनॉमिक एक्टिविटी हुई है और हमारे पास में नंबर्स ऑलरेडी आ चुके हैं, तो इस वजह से कुल मिलाकर के इस वर्ष का जो ग्रोथ फोरकास्ट है वो बढ़ा है.
धन्यवाद सर. अगर समय मिला तो बाद में पूछ लीजिएगा, बाकी सबको मौका मिल जाए. धन्यवाद सर. नेक्स्ट आई रिक्वेस्ट स्वाति भट्ट फ्रॉम रॉयटर्स. स्वाति प्लीज.
Thank you, sir. So, at the RBI for the last decade or so, largely the focus has been on reducing the banking sector risks. But now by easing the large exposure framework, allowing banks to, fund acquisitions, IPO financing, more in shares, aren't you in some way, making, inviting possible risks here? I mean, and what are we trying to achieve through all this easing? Can you just throw some light on that? Thank you.
We have taken measures very balanced, calibrated, thought out, considered. Even though we'll be doing a public consultation, even pre the formal consultation, a number of consultations, and there are measures on both sides. There are at least a couple of them, ECL, credit risk related capital adequacy norms, which I won't say which put high requirement, I don't think so, but it will be better targeted. Those banks, depending on the risks, some of them may have to provide, and keep higher credit. It will be better targeted. And similarly, some of the other measures that we have taken to enhance the flow of credit, improve the competitiveness of the banks. It's not as if those measures were not there at all. For example, project finance, we were already allowing project finance. Project finance for infrastructure companies was already allowed. We have not seen, acquisition finance. For acquisition finance was not, was already allowed for infrastructure companies, and now we have expanded it. Similarly, the loans against shares, etc., or for IPO financing, it was already there. It was not revised for a number of years. So it's but natural that, we revised them. I think on the whole, all these measures taken together, and we'll continue to take more measures, as and when required. Always the aim will be to promote the stability while at the same time improving competitiveness, encouraging and enhancing growth of the economy. Want to come in?
Sir, I think as Governor has already mentioned...
Because number of measures actually, these measures pertain to the regulation division. I request DGMRR to...
I think most of the measures have been well thought out and calibrated, one. Second, the banking system's ability to handle the risks has improved over the period, so there is some enough provisions. Third, most of the measures have enough guardrails built into them to safeguard the interests of the banks and the financial system. And speaking of the loans against, I think the limit has gone from 80 to 1 crore. I think the limits were last 1998. So overall, I think it has been a calibrated set of measures, and again, it's coming up for public consultation, so we will take the feedback and revise it if appropriately required.
Thank you, sirs. Next, we'll have Mr. Vishwanath Nair from NDTV Profit. Vishwanath.
Hi, good afternoon, Governor. I'll go back to your first speech as RBI Governor, where you spoke about the cost of regulation and the ease of regulation. Are we to see these 22 guidelines or whatever indications of guidelines that you've listed out in today's speech as a move towards that? Because while ECL is a very necessary and very delayed sort of framework that is coming in, a lot of others seem to be giving banks whatever they were asking for. Some of it, like for example, acquisition financing was something that banks have been speaking very vocally about over the last few weeks. Is that how we should see these moves?
Yeah, see, circumstances change, times change, requirements change, and so nothing should be frozen in time. And so that's why we had earlier also said that we will be continuously reviewing our regulations. In fact, we have decided in the FSDC under the chairmanship of the finance minister, where all the finance sector regulators come together to review each and every regulation every 5 to 7 years. So while we are doing that, and while it will be a continuous process, as you are mentioning, some of these things which have come our way, we have thought it appropriate to revise them, and that's it's very important that we continuously revise, review, improve our whole regulatory ecosystem.
Thank you, sir. Next, we'll have Mr. Anup Roy from Bloomberg. Anup, please.
Thank you, sir. Sir, in the policy you mentioned about rupee reference rate with trading partners.
now with major trading partners. So far we have 4 rupee reference rate, and now it will be expanded. So what are those currencies? And also I wonder what will be the benchmark reference rate that you will use, and will that also increase rupees trading in the international market? Like what I mean is that earlier there used to be a cross currency like INR USD and then USD say CNI. How will you fix that?
Yeah, I think the objective is that you minimize the use of crossing currencies to get rates. That will help both our currency as well as the other currency. We are currently looking at a couple of currencies. We are looking at Indonesian rupiah as one. We are looking at AED for another. But there are a few others. We will gradually keep taking them up. About your question on how do we set the benchmark? We'll have to see. We'll have to see because there are not many active transactions to begin with. So the process FBIL has to work out, what is the best way of initiating something. This is a case where, the pricing, the reference has to be shown first, and the market has to pick up from there. So keeping that in mind, we'll have to work out ways of, how do we arrive at what benchmarks do we use for these reference rates. Thank you.
थैंक यू सर. अब मैं जी बिजनेस की एकता सूरी को आमंत्रित करूंगा कि वे अपना प्रश्न पूछें.
गुड आफ्टरनून सर. सर मेरा सवाल यहाँ पर आम लोगों से जुड़ा हुआ है, उनकी जेब से. मैं ये पूछना चाहूँगी कि पिछली पॉलिसी से लेकर इस पॉलिसी तक 2-3 खबरों ने बहुत तूल पकड़ा हुआ है. सबसे पहले तो ये कि क्या बैंकिंग सेक्टर का ये कहना है कि जिस तरह से यूपीआई ट्रांजैक्शंस बढ़ रही हैं, हमारे इंफ्रास्ट्रक्चर पर बहुत बड़ा एक तरह से बर्डन भी बढ़ता जा रहा है, लेकिन कॉस्ट उतनी हमारी रिकवर नहीं हो रही. तो क्या आने वाले दिनों में यूपीआई ज़्यादा बड़ी ट्रांजैक्शंस पर किस तरह की कोई फीस लग सकती है? और दूसरा एक खबर ये कि यहाँ पर बैंकिंग सेक्टर का ये कहना है कि हम होम लोन में हमारे पास घर गिरवी है या गोल्ड लोन में सोना गिरवी है, लेकिन जब हम स्मार्ट अप्लायंसेस की बात करते हैं, जैसे स्मार्टफोन हो गया, तो यहाँ पर रिकवरी पॉसिबल नहीं है. तो क्या बैंक्स उसको रिकवर करने के लिए पुराने वाले तरीके पर जा सकता है कि जहाँ पर फोन लॉक हो गया अगर आपने किस्त नहीं भरी? और जिस तरह आज सेबी का एक वैलिड हैंडल जो लॉन्च हो रहा है कि अगर मैं पैसे भर रही हूँ किसी को तो मुझे पता चल जाएगा कि ये फ्रॉड है, ये सेबी रजिस्टर्ड नहीं है. तो ऐसा ही कोई ऐसा प्लेटफॉर्म कि अगर मैं किसी को पैसे ट्रांसफर करूँ तो मुझे ये समझ में आ जाए कि ये एक फ्रॉड अकाउंट हो सकता है या मैं इसमें फंस रही हूँ.
3 प्रश्न. पहला, यूपीआई पे क्या कोई चार्ज लग रहा है? तो ऐसा कोई अभी हमारे सामने ऐसा कोई प्रस्ताव नहीं है. दूसरा, आपने कहा कि क्या मोबाइल फ़ोन को जो लोन दिया गया है मोबाइल फ़ोन खरीदने के लिए, क्या उसे लॉक करने की इजाज़त दी जा सकती है या नहीं दी जा सकती है, जिस प्रकार से अन्य गृह लोन के लिए या ऑटो लोन के लिए इजाज़त दी हुई है. ये मामला अभी परीक्षणाधीन है. हम इसको क्योंकि इसमें दोनों तरह से हमारे पास में तर्क और वितर्क आ रहे हैं, उनका हम अध्ययन कर रहे हैं. हमारा ये प्रयास है कि जो हमारे ग्राहक हैं, कंज्यूमर हैं, उनका जो अधिकार हैं, जो डेटा प्रिवेसी है, वो सुरक्षित रहे. कंज्यूमर इंटरेस्ट, ग्राहकों का इंटरेस्ट, हित, वो सर्वोपरि है. साथ ही साथ जो लेंडर्स हैं उनका इंटरेस्ट भी किस प्रकार से सुरक्षित रखा जा सकता है, ये मैटर अभी अध्याधीन है. तीसरा आपका प्रश्न था फ्रॉड के बारे में शायद, राइट? उसके लिए कुछ कार्य हम लोग, ये एक गंभीर विषय है, इसके ऊपर में हमने कई कदम पहले भी उठाए हैं और निरंतर हमारा ये प्रयास रहेगा कि किस प्रकार से हम जो फ्रॉडुलेंट तरीके से एक अकाउंट से दूसरे अकाउंट में पैसा निकाल लिया जाता है, उसको हम किस प्रकार से रोकें. उसी क्रम में पहले हमने आपको म्यूल हंटर के बारे में बताया था. उसी प्रकार से एक अन्य जो एक एक्सपेरिमेंट, ये अभी एक्सपेरिमेंट की स्टेज पे है, अभी इसको पूरी तरह से हमने लागू नहीं किया है. उसको हम अभी जो हमारा सॉफ्टवेयर है हम तैयार कर रहे हैं कि किस प्रकार से पूरी इंफॉर्मेशन लेते हुए पहले से ही यदि हम ग्राहक को ये सचेत कर दें कि ये एक रिस्की ट्रांजैक्शन है, आप इसको न करें। तो उसके लिए हम अभी प्रयास कर रहे हैं। अंग्रेजी में यही बात कहने के लिए मैं हमारे डीजी को निवेदन करूंगा, वो आपको अन्य सबके लिए ये तीसरा वाला जो प्रश्न है अंग्रेजी में सबके लिए, और दूसरा वाला जो प्रश्न है जो मोबाइल फ़ोन के बारे में है, मैं डीजी MRR को बोलूँगा कि वो अंग्रेजी में इसी चीज़ को वो रूपांतरित करें।
Yes. Yeah. No, I will not try to translate what the governor said, but yeah, it's basically this: the digital payments intelligence platform. You would recall that RBI had set up a group; it had announced. We are now implementing it, as the governor said. The actual prototype is getting developed by our innovation hub. An entity is being set up to run this. The basic idea behind this platform is that you collect information from whatever sources are available: mule accounts, telecoms, geography, where the call is coming from, and whatever else, whatever information is available. And you have an AI system which is being trained on this information. And the idea is that this system will alert before a transaction by saying that this transaction is risky. Based on the alert, the customer will have to take a call or the bank will have to take a call. So we expect that this will have a significant impact in terms of reducing, the number of frauds that we see in the system. By no means, I'm saying that the number of frauds are high. The number of frauds are well under control. If you look at number of frauds per transactions in UPI and others, they're quite low. But these systems will further lower those transactions. Thank you.
The issue of digital locking, which I think it had referred to, I think the issue is under examination, as Governor has pointed out. And there are pros and cons on both sides in terms of balancing the customer rights and requirements, data privacy, and also the creditor's requirements. So we are examining the issue. We will evaluate the pros and cons, and then take a view at a later point in time.
Thank you, sirs. Next, I'll ask Ms. Sangeeta Mehta from Economic Times. Sangeeta, please.
Thank you, sir. Thank you. Sir, my question is on forms of business. You all have relaxed the guidelines, and you have said that the board of the banks will have the discretion to decide. Why has RBI chosen to relax the norms? And sir, on one more thing on this, what would be the specific macro-prudential tools that you would be using for large exposure framework?
So, first thing, you are saying relaxation. Let me first of all clarify that that was only a draft. So it was not a final kind of a guideline or a direction. So the other thing is, see, we don't want to micromanage. We believe that the banks will take a conscious, considered, balanced view, depending on their needs as to how they wish to conduct their own business. And so that's why, we have just left it to them. Second question was?
What would be the
macroprudential tools? A number of them.
We have
I'll leave it to the
tools which are available. Maybe we can look at, say, putting a cap on the exposure from all the banks, because I think the fundamental point which Governor mentioned was the concentration risk. All the banks' collective exposure to a single entity. So we could think of limits for that, but that is something which can be considered at a particular point in time, if appropriate.
And then we have supervision.
Yes.
Also. We can also put in supervisory measures in case required.
This will be draft first.
Yes.
This is final now.
Forms of business is final.
Yeah. Forms of business is final.
No, the large credit.
That is draft. That is a draft circular.
Thank you, sirs. Next, we'll have Mr. Ashish Agashe from PTI. Ashish, please.
Thank you so much, sir. So a quick follow-up to Vishwanathan's and Swati's questions. So earlier there was a perception that financial stability sort of foregrounds RBI's approach on things. Are we to now understand that it's a sort of turn towards being more pragmatic? And so second quick question, so how do you look at these adverse weather events right now? Since the last policy there have been more. So how do you look at this from an inflation and growth perspective?
I don't think, that you should see these measures as any kind of a relaxation or kind of letting go our sight, from financial stability. Stability is foremost for us. Whether it is price stability, whether it is financial stability, that is foremost not only for us, I think for the country as a whole, it's very, very important. Because if you do not have price stability, there are consequences. Similarly, financial stability, one episode of financial instability can take you, many years behind. So all of us need to be very conscious of that. At the same time, we have to be very careful. We have to ensure that we are not in any ways impeding growth or limiting whatever are the fulfillment of the genuine requirements of the various productive sectors of our economy. So financial stability, price stability will continue to be the primary focus of the Reserve Bank, as it is for all other central banks as well. Weather-related events, yes, they do have an impact on both growth and on inflation. There have been a number of them. At the same time, let's also keep in mind that the government has also put in place a number of measures now. The supply chain management is much better, and they are able to respond to them better. And so that's why we have seen that over the years, despite there being more weather-related events, as you mentioned, inflation has been much better behaved. It's been lower, last 10 years vis-a-vis earlier 10 years. So, and at the same time, we will also do whatever is required for the health of our banking system to be able to take care of any weather or climate-related risks.
Thank you, sir. Next question will be from Mr. Ankur Mishra from ET Now. Ankur, please.
Thank you so much for the opportunity. Hello, sir. I want to ask you regarding the rupee depreciation, which you have mentioned in the policy also, you will take measured as and when required. In the MPR, the revision of exchange rate has been there from 86 to 88 this time. I want to understand from you, is the current exchange rate comfortable for you? And also talking about MPR, you have made projections for inflation also 4.5%. In that context, keeping the neutral rates and talking about the real rates here, it is below the estimate. How much of the scope of then easing is there for you?
What is below the estimate?
Real rate. 4.5%, sir, is the projection which has been given in the MPR.
Okay. So, your first question was on?
Rupee.
Rupee. So, rupee, see, we do not, you asked me, whether you're comfortable with this rate, etc. So, we do not target, any level or any price band. Our effort has been to manage any undue volatility, and we will continue to do so. Insofar as you are saying the real rate is concerned going forward, you are saying is 4.5%, that is in Q1. So there are a number of things, which go into it. And it's not only inflation that we have to look at, we have to also look at growth in our overall in our monetary policy. And so, based on that, we have continued to retain the policy repo rate at 5.5% and the stance at neutral.
Thank you, sir.
Thank you, sir. Thank you, sir. Next, we'll have Mr. Mahesh from Financial Express.
Thank you, sir. With all these measures taken, are you still seeing any green shoots in the Capex happening in this country, especially with the large corporates, apart from the infra and the renewable sector? Thank you.
We had a good number, no? In Q1, we had a good, healthy number. A lot of sectors we are seeing good demand. I think cement, for example, auto, a lot of other sectors, they are seeing a good demand for Capex. And on the whole, we are confident that Capex will further going forward revive. Private Capex will revive.
Thank you, sir. Sir, next it will be Mr. Aryan from Informist Media. Aryan, please.
Thank you, sir. This question is for both the Governor and DG Gupta, if possible. The MPC resolution said that the MPC was waiting for the impact of prior steps to take further action on rates. Eventually, the transmission of the prior actions will take place. Considering your growth and inflation forecasts for the next few quarters, what do you think will stop you from cutting rates, especially considering the real and nominal GDP? The real and nominal GDP numbers in the June quarter painted very different pictures of the economy. Thank you, sir.
Leave it to you.
Sure. As you know, monetary policy is a forward-looking response. So while Q1 numbers have actually been surprisingly good, as you said, but there is some softness projected in the second half of the year. And inflation numbers have also been surprisingly very, very benign. So I guess taking into account both of those developments, as we said in the statement, some room has opened. But it has to be contextualized with everything else that's happening, both domestically and globally. So it's a fast evolving, very, very fluid situation. Yes, Q1 numbers have been good, but those are only one factor in the number of things that we consider for monetary policy action. And that is an important factor, but it's a backward-looking factor. So to that extent, you know, there is room, but as has been said and has been also repeated by Sir, a number of other things will be taken into account before deciding the next action in December.
Thank you, ma'am. Next, we'll have Mr. Laltendu ji from Hindu.
Good afternoon, Governor. You have partly answered my question that I'll be asking. This is about the impact of the tariff on the Indian economy. Have the RBI or the MPC mapped different, the impact into different sectors? Thank you, sir.
Yes, we have we have the map. We have the details. You are aware, which are the sectors: gems and jewelry, shrimps, textiles. Now maybe a little bit of very little extent, generic branded pharma, which has now come in later, footwear. These are the primary sectors, which will be impacted.
Thank you, sir. Next, we'll have Ms. Subhana from the Mint.
Hi, sir. So, sir, I wanted to go back to the first question on monetary policy transmission. You said that and there has been an impact of yields have gone up by 30 to 35 basis points. Now, that has gone up since the June monetary policy, and we've seen some headwinds on monetary policy transmission. So, what is it that is RBI concerned about this monetary policy transmission getting impacted through the bond channel? In your assessment, would you bring back OMOs or GSEC purchases? In what way would you signal, to ensure the market that the policy repo rate adjustments, would feed through long-term rates?
See, the primary tool that we have for monetary policy transmission is the policy repo rate, and align the policy, the operational target, which is our Walker, to the policy repo rate. Last month, it was at 5.46%. There has been broad-based transmission, as I mentioned to you, across all sectors, whether it is money markets, bank credit, even corporate bonds. Corporate bonds are down from their peak by 50 basis points, 5-year AAA corporate bonds. And similarly, for other bonds also. Similarly for government securities also. It's a process, it takes time, and we are hopeful that the transmission will take place, even in other sectors. Please also keep in mind that even in 10-year, as I mentioned, it's about 25-30 basis points. Only because of monetary policy, it had decreased by even more, 60 basis points. There have been certain developments after that. The other thing is, 10-year will not move 1:1. Let's keep that also in mind. So 25-30 basis points, while there is scope for more, and we feel that it should head downward. A number of measures have been contemplated in this regard, including, how the primary GSEC auctions will be held, the tenor of these government offerings, not only central government as well as state government. We are quite confident that monetary policy transmission will happen, even has already happened to a great extent, and will continue going forward.
Thank you, sir. From the left-hand side itself, Mr. Ben from New Indian Express. Ben, please.
Right, sir. What is a complaint or a suggestion? The RBI statements and releases are coming too late these days, and in too many bunches. It could be given on a reasonable time. It could be, we can't do a better job of that. Like that banking, the regulation, 7 regulation changes, it came at 10:20. Or the bulletin came, last bulletin came at 11:30 or something. It's beyond our capacity to manage.
We work 24/7.
So I don't think.
I get the point, and we will endeavor that we bring them out. What time do you want them out? By 6 p.m. Okay.
Sir, my question.
All right, that is the Reserve Bank of India governor, repeatedly talking about how there is no letting go of oversight when it comes to financial stability with this, 22 other measures that have been announced, relaxations for the banking sector primarily. There will be enough guardrails that will be put into place when all of these regulations are announced, and it will only be done after public consultation. But that said, this is a big shift coming in, from the spate of regulatory tightening that we've seen in the previous few governors' regimes. Whether this is capital market financing, removing limits, allowing acquisition financing, lending for IPOs against debt securities, or, easing the risk weights. RBI has said for MSMEs, residential real estate, for NBFC lending to infrastructure, all of these, mark really a sea change, a large exposure framework, easing that also that the RBI is talking about. So you had the RBI top brass addressing that. And of course, back to the policy, the pause that has come in expectedly with the RBI leaving room for more rate cuts on the table by saying that the lower inflation print does open up some space for action. action in the future. On that note, let me welcome our esteemed guests on the show. Neeraj Gambhir, Group Executive and Head of Treasury Markets and Wholesale Banking Products at Axis Bank, Pranjal Bhandari, Chief India Economist at HSBC, and Soumyakanti Ghosh, Group Chief Economic Advisor at State Bank of India. And also with us for these banking regulations is Anil Gupta, Senior Vice President and Co-Group Head at ICRA. Thank you so much, all of you, for joining us here. Anil, let me start with you before I go to the economists. You know, this series of measures, banking reforms, as the RBI is calling them, that it has announced, you know, whether that is, you know, the overlapping businesses that, you know, RBI has left to the discretion of boards, allowing, you know, acquisition financing, lending for IPOs against debt securities. What do you make of these changes and the kind of additional credit this will unlock for banks to capture back market share from other financial players?
Yeah, thanks. So it's difficult to quantify maybe the incremental credit flow which may flow because of these relaxations, but definitely the measures which have been announced are in the backdrop of slowing bank credit growth, and all these measures, maybe especially the enhancing that removal of the circular on enhancing the borrowing through market mechanism for large borrowers, that is going to have maybe a favorable impact in terms of maybe credit flow, because that circular especially involves maybe larger corporates to borrow maybe 50% of their incremental borrowings through market mechanism. While that is possible for larger well-rated companies, but for large maybe companies which are rated in lower rating categories, it becomes difficult for them to raise 50% of their incremental borrowings from the capital market. So that should improve the credit flow to these corporates and should be beneficial for the overall bank credit.
Anil, let me specifically get from you some of the names, for instance, and forms of business, you know, this circular being withdrawn. HDB is the clear standout beneficiary. For other banks, who are the ones that stand to benefit?
So, like all the large banks will have subsidiaries operating into, let's say, insurance, NBFCs, capital market businesses, merchant banking activities, broking. So, while maybe some of these businesses, let's say, are not overlapping like insurance, capital markets, but the major concern was on the lending piece, which is done by through the NBFCs of these large banks. I think the intention is basically to give the free hand to these banks to continue lending, because see, these banks operate and cater to different customer segments through bank and their subsidiaries. These customers may require maybe a different kind of a setup. Even the employees which are working in these subsidiaries may have a different skill set. The branches which these subsidiaries will have a different skill set, a different setup. So basically, working the same product which is being catered by a subsidiary through a bank is very, let's say, less feasible. So that gives a lot of headroom for these banks to maybe cater to a wider segment of the customers and in wider product segments also.
Well, Anil, hold on. I'll come back to you in just a bit. Pranjal, quickly, your takeaways. The pause, as expected, has come in, and the RBI does seem to have left room for rate cuts in future.
Yes, absolutely. You know, going into the meeting, we were forecasting a dovish pause, and I'm still surprised at how dovish the pause was. A couple of reasons. You know, one is the commentary on inflation, the fact that, you know, they said clearly that there has been significant moderation. They've cut all kinds of inflation forecasts for FY26, first quarter FY27, fourth quarter FY27. Similarly, with growth, you know, they've mentioned clearly that growth is below aspirational levels, and then they've cut the second half of the fiscal year growth numbers as well. It can be asked whether does that mean they will cut or not, and my sense is they gave both direct and indirect indication that they are open for more easing. One is that they said that more space for easing has come up. The governor also said that this is communication, but we also want to follow it up with credible action. So I think that was sort of a direct inkling that, you know, some rate easing could come in the future. And I think there was some indirect way of communicating that as well, with 2 of the 6 MPC members actually preferring a accommodative stance at this point of time. I think that's a really big signal. So all of this makes me feel that if, you know, we go into December policy and the 50% tariff is still there, and I think that's the main thing here, the 50% tariff, if it's there, then I would say that there could be easing in December and also in February. But I think a lot depends on the tariff rate at this point of time. Quickly, one more thing. I think the governor also said in his in the press conference right now that at this point of time it is not clear, but over a year, I think it will be clear to them that the negative impact of the high tariffs can be more than the positive impact of GST tax cuts. And that is why they have brought down their second half of fiscal year GDP growth numbers. So if that were to be the case, then I would say that December is going to be a rate cut.
Okay, Pranjal, that was quite comprehensive. Thank you. I mean, that is a list of things that makes this policy sound more dovish than we'd expected. Soumyakanti Ghosh, you had gone into this policy expecting a 25 basis point cut, which has not come. What is your base case scenario? We don't know how the tariff negotiations will go. What happens in December and thereafter?
No, thank you, Ritu. I think the policy is, if I look into this policy is basically very balanced communication in terms of rate space opening up in the future. But beyond the rate cacophony, this policy is actually beyond the rate cacophony, and it is actually a very good policy in terms of addressing the market microstructure. And if I have to borrow Ben Bernanke, it's constant policy discussion that is based. I think all these measures which we have mentioned in terms of the large exposure framework, the deposit risk insurance premium, and also the mergers and acquisition will do two things. First, it will increase the bank lending significantly, and also it will come at an affordable cost, because the transaction cost will also decline because of the many complexities around this circular. I don't want to get into the details, but the point is that, so this will serve the purpose of not only making the regulations more transparent, more constant, but also it will move in the direction of reducing the transaction cost of the banks. Now, having said that, coming back to the policy, I think if you look into the policy inflation projections, it was 4.2% at the beginning of this year for this current fiscal. Now it has been reduced to 2.6%. So there is a 160 basis point reduction. On the growth front, we moved up to 6.7. Now we have moved, then we came down to 6.8. Now we have moved back to 6.8. And if you actually very closely look into the RBI inflation revisions and the GDP revisions over the last 7 to 8 years, you will find a distinct pattern that even if the RBI inflation projections have been downwardly revised, but if the GDP numbers are not adjusted, the rate cut doesn't come in the policy. So possibly if you look into the numbers right now with the GDP growth rate being adjusted in the second half, I think that will open up space for possible rate cuts, maybe in December, maybe in February. The timing we can always debate. But as of now, I think the policy is clear in its communication that inflation is headed down, and the only way why the rates have not been cut in this policy is one to look through the prism of uncertainty. But the question remains there that even if we may wait for the uncertainty to recede, there is no guarantee that it will recede in the next couple of months. So it can actually increase. So it can cut both ways. But my sense is that the policy has given enough indications of further easing in the next couple of months.
Okay, thank you for that. We have to take a mandatory break. Mr. Neeraj Gambhir, when we get back, we want to ask you about how the bond markets have, absorbed this policy. But we have to take a break. Back in just a moment to continue this discussion.
After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%.
Welcome back. We continue our monetary policy discussion with a whole host of experts. Mr. Neeraj Gambhir, just before taking the break, we were talking about the bond markets. Perhaps OMO is not something that the governor said, but plenty of dovish commentary. The 10-year now at 6.56. Where do you see it settling, and some of the biggest takeaways for you from this policy?
Thanks, Ritu. But before I go to the bond market commentary, I want to say something about the overall direction of this policy. I think it's really a breakaway policy and standout policy for me as far as the number of regulatory changes in the banking sector related changes that they have introduced. Some of these are long-standing demands, for example, allowing banks some kind of a role in M&A financing. Some of these are basically changes that were in the draft stage, for example, the forms of business circular. And some of these were changes that they have recently made, for example, the changes with regard to opening current accounts. As far as the current account discipline circular was concerned. So these are very, very significant and important changes, and some of these changes will have quite a bit of bearing on the way banks function. Of course, for many of these, the devil will lie in the detail as to the exact form of the circulars and what is permitted and what is not permitted. Coming to the bond market, I think the market was expecting a little bit of a dovish bias in this policy. But I think the dovishness in the policy is a little bit more than what the market was expecting. So we've seen some pullback in the yields, even although not very much. The key issue for the market is two. One is that we're going to have significantly higher supply than what the current demand seems to be. So we seem to have some kind of a demand-supply mismatch. Second, we're going to have a new 10-year bond. And as a result of that, the old 10-year bond seems to be sort of going a little bit out of the favor. So that's having some kind of a bearing on that yield. But even if we were to get a 25 basis point rate cut in December, which is what the market will likely play for now, I do expect the long end of the bond curve not to do much. Most of the benefit will be seen at the front end of the curve. So maybe up to 5-year part of the curve will see a much better outcome if there were to be a rate cut in December or even in February.
Okay. Well, may I butt in, Ritu, with your permission? We've just come down from the press conference. Soumya, I wanted to ask you, I specifically asked him, you have dropped the word limited. In an earlier instance, you said it gives us limited space for accommodation, and now you say there is space for accommodation. Do you get the feeling that it is not one but more than one cuts possible because they have wantonly dropped that word?
Yeah, it could be possible, Lata, because as of now, they have moved the needle from 4.2, if you remember, in the April policy to 2.6 now, and they have moved the needle from 4.9 to 4.5. So in December, there could be further, if the inflation trajectory behaves like that, and there could be some more downward revisions in February. So if it goes down, there could be space could open up actually for maybe more than one rate cut. Where that will happen, whether in December and February, that's a matter of open debate. But I think the communication is very nuanced and structured and positive for the markets because it gives a clear signal that the central bank, as you correctly said, has moved beyond the limited rate action to rate action, so which could be not in single digits, it could be also multiple. So that's, I think, the bottom line. And separately, I think I was just speaking to Ritu also, I think the market is actually beyond the rate cacophony in terms of improving the market microstructure.
Oh yes, of course. As Neeraj says, that makes it a standout policy because of the many deregulations that have been announced. But Pranjul, would you agree? Does the tone sound like more than one cut?
I think so. I think, we waited this time around, despite inflation being low, growth being lower. We still did not do a cut this time because there are a couple of uncertainties still. And one big uncertainty is what really happens once Diwali is over. In the run-up to the Diwali, we have GST rate cuts, meeting Diwali consumption demand. And all of that is holding up growth over September and I would say even October. And we are seeing it actually very clearly. We are seeing in PMI, new orders are falling, but export orders are falling, but domestic orders are rising. So we have some offset because of the GST tax cut right now. But once Diwali is behind us, then I think sentiments towards growth will worsen very quickly and rapidly. If 50% tariff is still there at that point of time, then I think we are geared for 2 rate cuts, and I would say over December and February. But a lot depends on the 50% tariff. Lata, since you asked, I want to also mention one thing. For me, the standout was not just the dovishness and the regulatory points mentioned, but also discussion on the currency. We are also very used to RBI talking about how they only lower volatility in the rupee. But this time around, they actually went ahead and mentioned that appropriate steps will be taken on the currency front, and they're watching the currency very closely. I've never really seen this in the past, and my sense is I won't be surprised if over the next year we start seeing a lot more steps on attracting capital inflows into the economy. I think even some of the regulatory steps today, for example, re-looking at the ECB norms, also this whole banks M&A financing, which could indirectly get some FII money in. I think all of that also has one eye on the rupee and capital inflow. So I would just sort of leave that on the table as well.
Okay. Well, I wanted to, I take your point that he was a little forthright on the rupee, probably to scare away speculators, was the way I saw it. But yeah, we may have capital attracting steps. But I wanted to ask Neeraj, for the same reasons that you say it stand out, more acquisition finance possible, more loans against shares, more loans against debt, more IPO financing. Will credit growth be a different number given all this? I mean, if you were forecasting 10, will you forecast 12 now?
I think more than the credit growth in the near term, of course, this is all subject to the finer detail that comes out. I think what was happening was that certain forms of financing was increasingly moving away from banking system into NBFCs, into mutual funds, into FPI investments through the VRR kind of route. And what this does is to bring some of that financing back into the banking domain. So effectively, it's kind of making banks far more relevant now for the corporate borrowers. And for corporate borrowers, the financing requirements are changing. It's not only about working capital, it's not only about Capex, but it's also about a whole lot of other things that they want to do. And that includes acquiring, assets both domestically as well as offshore. So again, it's subject to what the fine print is, but it brings a lot of that financing back into the banking system domain.
Okay. Actually, you're right. Probably NBFCs will lose if banks do more of capital market financing. Maybe the total will not improve. But Soumya, would you bet higher capital, higher loan growth Have you changed your number from what it was before the policy?
No, I think, Lata, of course, it will lead to higher loan growth. If you remember, I think this large corporate exposure framework we had also mentioned earlier that it is actually leading to more external commercial borrowings on the part of the banks. So banks will actually now look more inwards. And just to give an example, I think that 50% norm over rupees 10,000 crore was applicable if the banks were to make a 3% provision. So now this 50% norms is going. So that will obviously lead to a significant transaction cost, the rate of interest also on the part of the banks. The corporates will have also better bargaining power. And my sense is that this deposit risk insurance premium, mergers and acquisition or LF, all these measures will actually propel the credit growth. So that I think is one of the positive developments from this policy.
Well, Anil, very quickly, we've spoken about the forms of business and the, that 10,000 cap, etc. But this expected credit loss also, the expectation was it would come in earlier. Now RBI is talking about 2027 with a 5-year ahead glide path to meet those capital requirements. To what extent had banks already prepared and how much more headroom will this give them? This kind of an easing over multiple years to get to the level that is required per the norms.
Sure, Ritu. So this discussion paper actually came in January 23, where this proposal was there to implement ECL for the banks. And at that point in time, based on our discussion with various banks, we estimated that it could have an impact on reported capital ratios, let's say core equity capital ratio, which we look at, of maybe around 300 to 400 basis points for the banking system. Maybe larger banks, private banks, have carried some floating provisions which can lead to maybe some kind of a lower impact. But at a system level, we expected maybe that if the ECL is implemented from April 2025, because the circular came in January 2023. So we estimated 300 to 400 basis point impact. Now we are saying that we will have 2 more years compared to maybe our initial estimates. So this will definitely moderate the impact from what we initially estimated of 300, 400 basis point. Now, because over 2 years, not only the banks have made provisions on their stress pools, second, the capital ratios have improved, NPA numbers have gone down. Also, the look back period when you will do your ECL modeling will not have that COVID period, which had a high kind of a stress on the asset quality. So the look back period for the modeling will throw up lower maybe PD and LGD numbers. So that will have an overall favorable impact on the ECL impact whenever it happens. 5-year transition frame was also proposed in the discussion paper. So not incrementally a new thing, but definitely provides maybe some headroom for the banks to transition.
Okay. That's a comprehensive reply. Thank you very much. Anil, thank you, Neeraj, Pranjal and Soumya as well for adding more color and helping us understand what the governor meant when he spoke at the press conference as well. Thank you, Ritu, for taking us through. The key takeaway really is that it is a dovish pause. We should expect 1 more cut. And as our economist experts say, probably 2 more cuts. And as Neeraj said, this is a brave new charter for banks. Much less or fewer regulations. And that's a breathing space. But will credit growth grow? That will depend on whether there is economic growth as well. And that's where Pranjal has raised some very important question marks given the global environment. Thank you very much for watching this special monetary policy coverage. It's time for a break now, and then I suppose a little bit of business lunch will follow.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I am Hormas Fatakia, and the markets have begun the October FNO series on a very positive note. The Nifty currently trading near levels of 24,800, 160 points higher on the index, and that is courtesy the Nifty Bank. And it is the Nifty Bank that has been leading the charge higher for the benchmark index as well. 650 points on the Nifty Bank, still hovering around that 55,300 level, but more importantly above the mark of 55,000. So good going for the Nifty Bank, and the index heavyweights are the ones that are leading the charge here. Take a look at that. ICICI Bank, HDFC Bank, Kotak, Axis, all of the private banking majors doing well. Not doing well are the PSU banks, SBI and PNB, and the PSU banking index in general has been sulking after the measures announced by the RBI in its policy. Of course, there are a lot of other triggers as well, considering the fact that we started the October series with record FII short positions. The long positions ratio was only at 6%. So there is, of course, that short covering factor to be taken into account as well. But for now, a good day for the benchmark index as of yet. But the big announcements of the day, the Reserve Bank of India announcing a slew of measures aimed at enhancing the resilience and competitiveness of the Indian banking sector. Ritu has been on top of this all day long, and she's here with the key takeaways. Ritu.
Well, Hormaz, I mean, this is the first time in over a decade of covering RBI I've heard of more than 20 banking-related measures being announced in a policy, and that has really been the story of this policy more than the monetary policy action. Whether starting with the expected credit loss, application for all banks, which was expected to kick in earlier. Now, RBI says will only come into effect from the 1st of April 2027, and even after that, banks will be given a 5-year glide path until 2031 to absorb the loss, to absorb any additional capital that they have to provisions that they have to provide for their loans. That is one. Secondly, and RBI is yet to give more details on this, to reduce the overall capital requirement for banks, RBI is also proposing to ease the risk weights for two key segments, MSMEs and residential retail, home loans. That is something we'll watch out for. The draft circular on forms and business, which had proposed that there be no overlapping business between the bank and its subsidiaries, has been scrapped. It was a draft, yes, it had not been implemented, but that had, put some sort of an overhang on companies like HDB Financial, for all banks that have these subsidiaries. That has now been scrapped and left to the discretion of bank boards entirely. Apart from this, for after more than a decade or more than a few decades, RBI is allowing banks to get into M&A financing. We'll have to see how much market share banks will therefore be able to wrestle away from other financial institutions now that they're going to be allowed to do this. The regulatory ceiling on lending against listed debt securities has been done away with. RBI has also increased the limit for lending by banks against shares from 20 lakhs all the way to 1 crore rupees, and for IPO financing from 10 lakh rupees to 25 lakh rupees per person. These are big changes when it comes to lending for the capital markets. Apart from this, there was a 10,000 rupee cap, for per specified borrower, above which, they couldn't borrow from the banking system. They would have to raise their money through the capital markets. That cap has been done away with entirely. As far as the large exposure framework is concerned, that continues on an overall systemic level, but RBI will look at more specific levels at a bank level. And infrastructure financing by NBFCs, the risk weights there are also proposed to be eased. So a draft of measures for banks and financial institutions that will surely have far-reaching implications.
22 measures. Well, a lot of them, Ritu. Thank you for that update. It definitely showing on the Nifty Bank in today's session. But the auto sales, the other big trigger for the day, and they have been trickling in as well all through the morning. Sonal is here to summarize the ones that have come in so far. Sonal.
Thank you so much for that. They've been decent so far, some of them even better than Nomura estimates. So let's start with the big one, that's Bajaj Auto, where their total sales came in at 5.1 lakh units, which compares with the Nomura poll of 5 lakh units. Total sales, that means, is up 9% on a YY basis. The domestic sales were up 4% on a YY basis, but this growth this time around was led by export sales, which was largely expected. So 18% growth on a YY basis for exports for Bajaj Auto. For M&M, let's talk about their auto business first, because that's where their total sales came in at 1 lakh units, which compares with Nomura estimates of 90,000 units. total sales saw a growth of 16% this time around. The tractor sales did really well, 49% higher on a YY basis, and this is higher than the estimates as well at 66,111 units. For Escorts Kubota as well, so it seems the tractor segment is doing really well. Even for Escorts Kubota, tractor sales were up around 47%. For Hyundai as well, the numbers have come in better than what Nomura was estimating. Some of their categories saw highest ever sales this time around, so Hyundai did well as well. For VST tillers, the total sales went up by 35%, so the agricultural segment, the GST cuts, all of it really aided sales for these companies this time around.
Indeed. Sonal, thank you for that update. GST definitely having an impact on these sales. But India's trade and economic partnership agreement with the European Free Trade Association is slated to come into force today. The EFTA bloc comprises of Switzerland, Iceland, Norway and Liechtenstein. And under this agreement, New Delhi has received an investment commitment of $100 billion in 15 years from the group, while allowing several products such as Swiss watches, chocolates and cut and polished diamonds at lower or zero duties. My colleague Parikshit spoke to the Norway ambassador to India on the trade pact. Listen in to what she had to say.
Well, I said India is the biggest market in the world. It will be the biggest consumer market. We are smaller markets comparatively. So of course it's a disparity in one way. But all EFTA countries, they have very clear technologies, cutting-edge technologies in different areas. That means that there is complementarity between India and the EFTA countries. And for Norway, they are particularly in the field of energy and green energy in the maritime space.
Now, the US government shut down following disagreements between the Congress and the Trump administration over a funding bill. This report tells you what it means for their economy.
The U.S. government shut down much of its operations on Wednesday as deep partisan divisions prevented Congress and the White House from reaching a funding deal. That sets off what could be a long, grueling standoff that could lead to the loss of thousands of federal jobs. The 15th government shutdown since 1981 commenced hours after the Senate rejected a short-term spending measure that would have kept government operations afloat through November 21st. Democrats opposed the legislation due to Republicans' refusal to attach an extension of health benefits for millions of Americans that are due to expire at the end of the year. Republicans say the issue must be addressed separately. There was no clear path out of the impasse, which agencies warned would halt the release of a closely watched September employment report, slow air travel, suspend scientific research, and withhold pay from U.S. troops. It will also lead to the furlough of 750,000 federal workers at a daily cost of $400 million. Democrats are under pressure from their frustrated supporters to score a rare victory ahead of the 2026 midterm elections that will determine control of Congress for the final 2 years of Trump's term. The healthcare push has given them a chance to unite behind an issue that resonates with voters. Along with the extended health subsidies, Democrats have also sought to ensure that Trump will not be able to undo those changes if they are signed into law.
I don't know, we'll probably have a shutdown.
Trump has refused to spend billions of dollars approved by Congress, prompting some Democrats to question why they should vote for any spending legislation at all. Independent analysts warn the shutdown could last longer than the budget-related closures of the past. Trump and White House officials have threatened to punish Democrats with cuts to government programs and the federal payroll. Last week, Trump's budget director threatened permanent layoffs in the event of a shutdown.
With that, we call time on this edition of Business Lunch. Thank you so much for watching. Midcap Radar.
After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. M&M, that's the stock on our radar, beat street estimates with total September sales coming in at 1 lakh units versus estimates of 90,000 units. My colleague Parikshit spoke to Nalinikant Gulaganta, who is the CEO of Automotive Division at the company, and began by asking about the festive season so far and the sales in the month gone by.
Just from an SUV perspective, domestic 56,233 vehicles is what we sold. That's about 10% year-on-year growth for the whole month. And commercial vehicles quite strong as well. 26,728 vehicles. That's about 18% year-on-year growth for the month of September. Now, as you know, because of GST, there's quite a bit of demand which got bunched up at the post 22nd of the month. So we're also tracking retails on the ground. So what I'm going to talk about is dealer-reported customer retails for the first 9 days of Navratra, starting 22nd onwards till now. Very strong traction so far. SUVs, the dealers are reporting about 60% growth compared to the exact same 9 days of Navratra last year. So it's an apples-to-apples comparison from that perspective. 60% growth in SUVs, and then 70% growth in commercial vehicles relative to what it was in the first 9 days of last year as well. So good start to the festive season, if you ask me. Of course, some of that is pent-up demand, which came through because folks were waiting for the new GST rates to come into effect on 22nd as well. But definitely the GST toll auto reforms have given us fillip to the demand portfolio as well.
Right. I would also like to ask you about how do you start October? One of the things that you have mentioned in your press statement is that the surge in festive demand has placed significant constraints on availability of trailers, and we are working to improve dispatches to our dealer networks within the constraints. So could you give us a sense of the kind of booking pipeline that you're working with, what kind of growth that we could see in dispatches, and how are you looking to address the shortage of trailers?
Yeah, it's a tough one to predict at this point in time. The demand is quite strong. The inquiries and walk-ins have been quite good as well. So it's not necessarily a demand constraint challenge we have. As an industry, we have a trailer shortage, primarily because most of the deliveries started happening post 22nd, so that we are able to take in the right GST into our invoices. So that's created a bit of a challenge in terms of trailers. And we are kind of working through it. One of the things we're doing is increased dispatches to trains is one thing we're doing. And of course, working very closely with our logistics partners, including Mahindra Logistics, to solve this problem. So it's something which will play into October as well. So hard to say at Parikshit at this point on what it will play out. We're of course super focused on making sure that we are able to dispatch the vehicles and we catch the festive in time. Having said that, of course, the demand will flow into November. We have also see that it's going to be a strong wedding season this time in November. So we're optimistic that we'll continue to get demand going into November as well.
Right. Now, if I were to ask you about the spread, the sales spread between rural and urban, what has been the sentiment like, and what would be the ratio of volumes coming to you?
Yeah, so just dialing back over the last 5 months, rural has been quite strong for us. And I'd say even for the industry, rural has done well. We've been quite happy with our urban performance, even in the last 5 months, although industry has struggled a little bit. But going into the festive, what we have seen early signs is strong demand for Bolero and Bolero Neo. And definitely strong growth for Scorpio and coming as well, which has a rural bend to some extent. So we continue to see that. So definitely that's continuing to play through. But urban demand has certainly come back in terms of walk-ins, in terms of inquiries. We see that urban demand has come back. Certainly has come back on 3XO, which is our compact SUV portfolio, and it's come back in terms of three-door Thar as well. But yeah, we're quite optimistic on the urban side this time going in the festive.
Right. So what would be the current ratio in terms of percentage of sales coming from rural, percentage from urban?
Yeah, so it varies, but normally when we come into festive, there's a little bit of an uptick in rural demand. So we are roughly about 50-50 at this point in time. And that goes back a little bit down on the urban side. But yeah, it's somewhere in the 50-50 going into the festive.
Right. Now, in terms of your top volume drivers in the portfolio, what would those be? The top 4 to 5 vehicles?
Yeah, Stop UN is definitely top of the heap there. Very strong demand, continues to be quite strong for us. And 700 goes right after that, renewed interest with the GST cuts which have happened. 3XO as well now with RevX, which are our new variants coming in, we're seeing significant interest there. So all of these models have seen cuts in excess of 1 lakh. If you take 3XO, it goes all the way to 1.5 lakhs, and that's on a CSUV vehicle. So significant demand coming due to that as well. But the interesting trend for us is also folks trading up in variants, right? And it's not like just because the price has gone down, they're actually spending less. They have the same budget, and they're looking to see if they can get a better variant for the same budget they have. So which is an interesting
outlook on EV sales right now. How much of that is coming in terms of volumes from your total sales?
Yeah, it's a good question. So when we started putting out our BEVs in Q4 last year, we were about like 2 to 3% of our bookings was coming from EVs. Now it's close to 8%. And we have an event coming up in November where we'll be unveiling a new EV as well. So our expectation is we'll stay in the 8 to 10% going forward of our overall bookings, which will come from EV. And then over a period of time, as we add more to the portfolio, new IQ as a platform we launched in August, as that comes in a couple of years, we will then start to go towards the high teens to early 20s.
Okay. Finally, I would like to ask you about, you mentioned a new EV launch coming up. How many total new product launches in this fiscal to keep exciting the market and keeping the demand momentum going?
Yeah, so we are focused on both on ICE and EV. We have an exciting launch coming up in the EV space as well, but we have a strong launch lined up in Q4 for the ICE side as well. So quite excited to bring both to the market. Both are very compelling products, and one will come in Q3, the second one will come in Q4.
Well, that was the management of Mahindra & Mahindra speaking to our colleague Parikshit. Very strong demand is what the company says they are witnessing. We'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%.
Welcome back to Midcap Radar. Well, all eyes are on the big LG Electronics IPO slated this month. My colleagues Manglam Malu and Shilpa Ranipeta caught up with LG Electronics India Chief Sales Officer Sanjay Chitkara and Chief Accounts Officer Atul Khanna and began by asking them about the rationale behind the timing of the IPO.
See, Diwali is a very important and it's a big season for our industry, and where consumer sentiments are high and our sellout are very good. So I think that's the right time for this IPO. And talking about our parents, I think it hardly matters where the parents are. Today our focus should be how the Indian subsidiary is doing their business and how they are growing and reinvesting in the market. I think the focus should be on that. And in that sense, LG is creating a benchmark. See, we came in India 28 years ago. And at that time, very few global players could able to recognize the long-term growth potential of India when we started our business. And from last 28 years, we have been working very hard to make consumers' lives good. And I think this IPO is a new future journey for us.
So we've had a lot of MNCs on record say that they're looking to cash out on their India chips to be able to reinvest in their own business back home. I just wanted to understand how that money will be utilized by them, because no money is coming into the company. It's an OFS.
So it's a, you rightly mentioned, it's a OFS where 15% equity parents are liquidating. And as I have mentioned, LG, we are reinvesting here in India. We are coming up with our third plant. It's in Sri City, Andhra Pradesh, where our $600 million US investment we are doing. And this is not only a conceptual stage. We have already done the groundbreaking ceremony in the month of May. The construction has started, and our plan is that by end of next year, sometime just near to Diwali, we start production there in our first line. And there will be a phase-wise investment, and by 2029, we'll finish this project. Notably, this plant is much bigger than our existing 2 plants. In size-wise, it would be roughly 3 times bigger, and we are doubling up our capacities. We are investing in new products, new technologies. We are also investing to improve the retail infrastructure in Tier 2, Tier 3 town, introduction of many new products. We are also scaling up our B2B business. That's our focus area. That is the HVAC, information display panels, e-blackboards. So a lot of exciting things are going on in LG these days.
Your financials are much ahead of your listed peers, whether it's even your return on net worth, even your PAT margin is much better than the industry. So on the face of it, it does look like the IPO is very conservatively priced. What is the sort of rationale behind this, conservative valuation that you're looking at? Is it that you're looking at leaving more value on the table for investors?
So you are very much right that any IPO of any company would depend on market sentiments as well as the strong fundamentals. Our fundamentals are very strong, and it has the IPO price band is being consistently directed and guided by our BRLMs, banking partners, and we are following their guidance and making it a room for our investors also to take some portion of that money into their own hands. So that is a very positive move, and we cannot call it as exactly the very lower times in terms of conservative, but yes, it is I will say optimally priced in terms of market sentiments as well as our banker guidance.
Let's talk about your numbers. Sales over the last 3 years have compounded at around 11%. Your margins have seen an improvement. So EBITDA has compounded at over 25 to 28%. Do you believe that these are numbers that can sustain going forward, or will you accelerate the pace of growth?
Let's not forget that we are serving to a structurally massive growing economy.
Right.
It's a 41 billion TAM for our products, if I leave aside the mobile phone business. And it's going with a 14% CAGR growth as per that share report. And it will become 73 billion US dollar market for us. And premiumization is happening. Currently, the India is sitting at a level of, say, around 17% as per that share report. And it will grow up to 25-27%. And LG has very strongly positioned itself as a very premium brand in India. So we believe that we will be the biggest beneficiary of this premium drive. And let's not forget that the penetration rate of our products in India is very low. A product like microwave, just 4% of household have, and air conditioner just 11%, a washing machine 21%. If we compare the other major economies like China or USA, they are sitting at 80-90% level.
So will you grow faster than the projected market growth?
Definitely. Being a sales leader, my intention is to...
That's your intention. Next to you is the accounts leader as well.
Our endeavor is always to expand our margins, and there are some reasons behind that we are expanding. We are doing a lot of investments into structuring our Indian, I would say, local insights as well as local sourcing, reducing the dependency on overseas buying. We are procuring almost 54% of the components and sub-assemblies in-house.
Right.
As well as our key endeavor is to all produce key components, heart of the product in our in-house factories.
So we have just a minute to wrap this. So we'll just do a quick fire here. You have to answer in as little words and as quickly as possible, right? Which one do you believe will be the category that will grow the fastest in your overall portfolio?
Air conditioners.
Air conditioners. Which will be the margin driver for the business in the next 3 years?
Or B2B businesses.
How much will that account for in your overall sales?
Currently it is around 8%, but it will definitely, the contribution will go up.
And services as a proportion of your sales are 2%, how much? 2%. How much will that grow to?
It is definitely 70-80% it will grow.
One new category that you probably are looking to enter that you're not already present in?
See, it's a competition sensitive information. I cannot disclose right now, but there are plans are going on.
One category which you don't believe is ripe for you to enter?
I don't think so, any category.
You shut your mobiles business, so one thought that
See, that was not a local decision. We did this in year 2021. And because we wanted to focus on where our strengths are there, that is appliances and TV, and we want to optimize our resources and investments.
A competitor that you are constantly keeping an eye out on.
Our last year performance.
That's a good one.
All right, that's the big upcoming IPO. We'll be watching out for that one. But for that, we'll slip into a short break. When we come back, we'll get into more stock-specific news and the market action as well.
MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance.
$1,200 crores, and that is the place where we know that there has been a massive equity dilution for all the existing shareholders because of all the troubles that the bank had gone into, and there was requirement of new capital infusion, getting the confidence back by having people like SBI, Kotak all chip in. And I think post the dilution, currently if we see the market cap at levels of around 2021, the market cap is 67,000 crore. Even if the gentleman were to wait to get his price back, which means that he will need to get a market cap of almost 3,35,000 crore. This is the type of market cap when, Yes Bank did have during its heydays, but I think looks very, very unlikely that that will happen anytime soon. This is despite the fact that recently SMC, Sumitomo Bank from Japan has taken a stake, and they will do all the right things, and already the bank has turned around, giving good return ratios. But I think it's going to be very difficult to get back to its price. At the best, I think if the viewer has confidence in this bank's long-term prospects, one can cost average, but we prefer investing into other private sector lenders like ICICI Bank or an HDFC Bank or a Kotak Bank for long-term purpose.
Okay. Saumil, your view for Yes Bank?
Yes Bank in the very short term, yes, definitely looking good in the very short term. Taken support at 20 daily moving average, high top, high bottom formations. Great setup, an inverted head and shoulder pattern is also forming. So I'll be expecting a target of 23 and 25 levels max. And I'm not suggesting to hold on for a long term or a medium term outlook. A short term trade is all right to me, but not in the medium term or long term.
But what is the level that they can keep an eye out on then in the short term? Because they bought it at around 100 levels.
In the short term, the target is not more than 25. So that's the target I have.
Okay, 25 is the target for short term only, not a long term story, according to Saumil on the charts and technicals. Let's move on but to the next query then. This is from Rajat Jain, who's writing to us from New Delhi. He's holding 200 shares of Tata Motors. Price is 100 rupees per share. Wants to know if he can remain invested for the long term for Tata Motors. Parthiv, your view for Tata Motors? Obviously, we have that division that's coming in now for the CV and PV. The record date has also come as 14th of October. But your view, they bought it at 100. 700 is what the stock is trading at. Should they book part profits or continue to just remain invested?
No, I think he can certainly hold on to this. One, his cost price is abysmally low. He's already sitting on 7 times returns on that. And I think today only it was announced that Tata Motor again regains the second spot in the passenger vehicle segment, which is I think a huge achievement, beating likes of Hyundai and M&M. So they are doing fantastically well in the domestic front, especially now that they have new pipeline of products in the EV segment. I think the volume growth should come back very strong. And that is what they're guided for, and all the stimulus that the government has given, especially for the premiumization and the premium car segment. I think that should should benefit likes of Tata Motors pretty well, who's focusing on that strategy. Even the JLR, I think, despite all the difficulties in terms of the business due to the tariffs, and more importantly, I think they are under a lot of cost-cutting measures. And the China market is expected to bounce back within the next 6 months. So I believe that JLR should also start contributing going ahead. And I firmly believe that the demerger move by the management, especially segregating the passenger vehicle division and the commercial vehicle division, I think it's a very good move because that will certainly unlock a lot of value, because we know that generally the CV segment is a lot more attributed with the cyclicality and doesn't come up high premium. So I believe Tata Motors is a good buy here and also hold on to the position for the long run.
Sure. And Saumil, your view for Tata Motors?
Tata Motors in the very short term, yes, it has done really well, and I was not expecting Tata Motors to start making high tops, high bottom, but I think from here on, short term definitely gets a target of around 740-45 levels, but in the medium term outlook, it has been making low tops, low bottoms. So I'll be waiting till 700, close above 750. Once we get a close above 750, I think the next level on the upside would be 820.
Okay, keeping an eye out on those levels over there. But on that note, we're going to slip into a very short break, viewers. Don't go anywhere. After the break, we'll still be discussing more stock-related queries. Stay tuned in for that.
Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with the neutral stance. Consequently, the STF rate remains at 5.25%,